Just to let everyone know that the session will start shortly. Just give another 2 minutes for all the registered attendees to be brought on the platform.
Good morning, professional colleagues, invited guests. We are about to start now. And we are going to start the free webinar on Nigerian tax reform bills with a national and ICAN anthem. We are starting by taking the national and ICAN anthem. National anthem, please. Secretariats. No audio. National anthem. I think they are still struggling with the national anthem. Maybe we just deem it as taken. Secretariat, can we still wait for the national anthem or we move on, please?
Để còn
Okay, please. We take the national anthem and the ICAN anthem as taken. So now I want to introduce the registrar, chief executive of the Institute of Chartered Accountants of Nigeria, to take the opening remark. After his opening remark, he will introduce the president, the diamond president of the Institute, for his remark also. Thank you. The RC, sir.
Yeah, thank you so much. Good morning, everybody. I appreciate you. Permit me to appreciate and welcome the diamond president, the assistant president of our great institute, the vice president, Malam Yaya Agno, the first DVP, Madam Queensley Sebusume, MNI FCA, the second deputy vice president, Dr. Felix Ostudi, the honorary treasurer of our great institute, Dr. Sheyi Olariwaju, the immediate past president, Dr. Innocent Ofosa, the chairman of this faculty, the prof himself, Professor Yomi Olugberu, the chairman and the coordinator for this advocacy program, one of our council members, Mr. Dele Oladipo. We thank you all for putting this together. As one of the mandates of the institute is to reach out to our members and the public at large whenever there is any issue of public discourse. And this faculty, together with the advocacy committee, put this together to sensitize our members, to inform them the importance of this bill to Nigeria, to the citizen at large. And that is why we quickly put up this free webinar together for all our members. And we appreciate the panelists for accepting our call, even despite the short notice we give them. We appreciate you all. Without wasting time, let me bring on board the 68th president of our great institute, the chief himself, the president that we call the due process president, talking about Chief JVC, Chizoke CV Alaribe, FCA, the 60th president. Mr. President, welcome to this webinar.
Thank you very much, my dear registrar, my professional colleagues. Let me start by acknowledging the presence of the Vice President, Chief Haruna Mayaya, FCA, the first Deputy Vice President, Hajia Queensley Stegosime, FCA, the DVP to Dr. Felix Etofulamo Suji, FCA, distinguished council members, the chairman of this faculty, Professor Olugbenro, chairman of district societies, the registrar, chief executive, members, great members of ICAN, the staff who are anchoring this program, distinguished ladies and gentlemen, not forgetting the array of panelists that have been put on here, Professor Albert Folorenshaw, FCA, who is one of the panelists, Chief Kunle Oyetoyan, FCA, sorry sir, if I murdered the name, but I know you very well. Mrs. Nike James, the tax partner from KPMG, State Internal Revenue Service, our good friend, Chief Nasrat Sabo Idris, PhD, FCA. I had earlier recognized the faculty board chairman, Professor Yemi Olugbenro, FCA. So I think formal introductions have been made so that I don't waste so much of your time. In an does not much because people want to take communion and go back to work. So this is an early morning event. By afternoon, we'll be done so people can go back to the office. So I'm very, very pleased to talk to you before the commencement of this very program. So the tax reform bills is a very current issue that is on the burner. So the faculty decided to put up this webinar so that we can think through the bill or the bills as an institute and articulate our position before forwarding it to the government or before publishing it. So please, apart from the facilitators, the panelists, members of the institute, after this seminar, please, we want to get a feedback. When one man sees a big snake, out of fear, he will say it is a python. But when there are people with him, he won't be afraid. He will look at it very well, and all of them will make a better description, whether it is a python or a cobra. So please, we expect every member of this institute to contact the registrar after this webinar. Let's hear your opinion. What do we forward to the public? What do we forward to the presidency, the National Assembly members? So it has to be the ICAN family position paper. So every member has to make his or her point known. So you can write to your DC Society chairman, or you can write directly to the registrar, or you can send it directly to me. We are going to filter it that we know what we're going to present. So that's why we decided to bring it when they want to look for a ghost in the village. All the villagers will come, because if some people are at home, they will think they are smelling like a ghost. So we are all here. So let's think like an institute and present a position paper and present our position on this bill. My dear facilitators, the panelists, I know you are experts in this. We'll all relax and hear you. So later on, we'll ask our questions, we'll articulate our points. Then as an institute, we'll be good to go. So on behalf of the Governing Council and the members of this great institute, I welcome everyone. So we'll all now relax and hear what those who know how to do this thing best. If you talk about football, there are people who know much about football, more than us. So our experts are here, Professor Lugbenru. So you and your team, we know what you can do. So on that note, I declare this webinar open. Let me relax now and listen to what will happen. Thank you very much, and God bless us all.
Amen. Thank you, our own Diamond President, Chief Chizoke, Chief David Chizoke S. Alaribe, FCA, for the wonderful remark. Now we want to go into the program fully. Good morning, distinguished professional colleagues, guests, ladies and gentlemen, once again. It is my pleasure to welcome you to today's discussion on the Nigerian tax reform bills, unraveling the salient issues. I am Dr. Yemisi Adedokun, FCA, and I will be facilitating this important conversation. The Nigerian government effort to reform the tax system are timely and commendable. The proposed tax reform bill aims to improve the efficiency and effectiveness of the tax system, promote economic growth, and enhance revenue generation. However, as with any significant reform, there are salient issues that require careful consideration. So today's discussion brings together experts and stakeholders to unravel this issue, share perspectives, and provide insight into the implications of the proposed reform. So in the next 2 hours or more, we will delve into the key aspects of the tax reform bills, which will include general overview of the bill, corporate taxpayer, benefit and concerns by corporate taxpayers, individual taxpayer, what should be of interest or concern to individual taxpayers, states and subnationals, the concern and benefits impacting state and subnational and implementation challenges, and concern by government-owned enterprises and revenue-generating agencies. Our panelists will share their expertise, and we will have ample time for questions, comments, and discussions, just as the president has mentioned. So before we begin, I would like to acknowledge again the presence of our Diamond presidents, the council members on the call, the registrar, chief executive, distinguished panelists who have taken time out of their busy schedules to share their insight with us. We are grateful for their contributions. So without further delay, let us commence this important discussion. I will start by inviting our first speaker and the chairman, Taxation and Fiscal Policy Faculty Board of ICAN, Professor Yomi Olugbenro, FCA, to share his thoughts on the topic, Nigerian tax reform bills, unraveling the salient issues. I want to read the profile of Mr. Yomi Olugbenro. Yomi Olugbenro is a partner and West African tax leader in Deloitte. He holds a first degree in accounting and master in business administration. He is an alumnus of the University of Manchester, fellow of the Institute of Chartered Accountants of Nigeria, fellow of the Chartered Institute of Taxation of Nigeria, and fellow of the Chartered Institute of Stockbrokers. He was a member of the Nigerian Presidential Fiscal Policy and Tax Reform Committee, and currently the chairman of the board of Tax and Fiscal Policy Management Faculty of ICAN. He has also served as member and dean of different faculties of different professional bodies, including Board of Indirect Tax Faculty and Board of Taxation Standard and Practice Monitoring Committee of CITN, as well as Consultancy and Information Technology Faculty Committee of ICAN. Mr. Yomi Olugbenro is a seasoned advisor with clientele cutting across many Fortune 500 companies, other globally renowned and locally strategic brands. He is highly sought-after speaker and thought leader on fiscal and economic policy issues, and speak regularly at local and international conferences. So in addition to his busy schedule as a business executive, he devotes a significant part of his life to spiritual, social, and charity work. He is patron to many youth associations in schools and colleges, faith leader and chairman of Free Indeed Foundation, an NGO that offers help to the vulnerable members of the society. So join me to welcome Mr. Yomi Olugbenro as he starts his speech. Thank you.
Thank you so very much. It's always a pleasure to engage with colleagues, because it's beyond the opportunity to present. It's always primarily an opportunity to learn as well. And I want to especially thank the Diamond President and the Governing Council.
Hello, sir.
Hello, can you hear me?
Yes, we can hear you, sir. We can hear you.
Okay, look like Dr. Yebisi couldn't hear me. I just want to be sure that other people could hear me. All right. Please, can I have a confirmation by other participants that they can hear me, please?
Yes, we can hear you very well.
All right. Thank you so much.
Thank you. Loud and clear.
Thank you. I appreciate that. So I was just acknowledging Mr. President and the council. The sheer number of them that's on this call actually lay credence to the importance that the council and the institute attach to this very important development within our fiscal space. And we felt it also at the faculty, because it was indeed a marching order from the president and the council to say, one, you must organize this as quickly as possible, and also to encourage members to attend it more free, so that as many people as possible can attend. So we really want to appeal the council for the gesture and for the support. So like the moderator has said, so what we are going to do during this session is that I will, first of all, present the overview. And the intention is to make sure that, because many of us might not have had the opportunity to read the bill in detail, we have seen headlines, and because it's a very voluminous set of legislation or proposed, we think it's important that our conversation, it's predicated upon some bit of additional insight. And to those who have read it or who are taking time to read it, I really want to encourage them and appreciate that you're doing that. But subsequent to that, we then have four speakers who will discuss and essentially come from a different perspective. So the overview will essentially attempt to explain and expose the bill to us as briefly and as quickly as we can, because it's quite a lengthy set of documents. From a layout perspective, I will try to spend some time just to do the context setting and give us the conceptual framework of proposed reform. And then the mix of the conversation will be around discussing the context, and some of the key highlights. And again, it will be key highlights because we're talking about a very voluminous set of legislation. But in terms of the philosophical direction, the key provision, you must know and you must be familiar with, we will discuss, and then we will try to wrap up with closing thoughts, and some remarks. So the idea is that when the overview is done, we then have more informed basis to appreciate and take in the discussions that will come from the different stakeholders, from different perspectives, companies, individuals, internally generated services, agencies, subnationals, and so on and so forth. So in terms of the context setting, I will not try to belabor this, but I thought it's important for me to refresh our mind from where we're starting from and the complaints that all of us we've had with our extant regulatory framework. We talk about the fact that there are fewer people that are paying taxes. We talk about low tax to GDP ratio. And when you take that as an example, it means the revenue yield to the country, relative to the size of our need is significantly small. But that's essentially just a symptom. Beneath that are fundamental issues relating to how difficult, how complicated, and how efficient and effective our laws are in taxing individuals and businesses. We speak to multiplicity of taxes. We talk about several agencies of government across multiple tiers, chasing taxpayers. We talk about the fact that sometimes the law are archaic, they are beginning to become so fragmented because of many amendments that, we all warmed up to with Finance Bill and Finance Act passage. And so the process became a lot more, cumbersome. Tax morale is low, and there are just so many. The list is endless if we're to continue to list what the challenges are. So this was the foundation or where we were when the idea of setting up a presidential reform committee was then sold to Nigerians by Mr. President. And maybe also to remind us, because I think this is important, so that when we're looking at the recommendation and the direction, it's easier for us to be able to link what the mandate, what the focus, what the expectations were. So when this mandate was given out by Mr. President, and our friend and a very well-respected member of the institute himself took up the responsibility to lead the committee, and put up, quite a sizable number of members and of people to support him. Our institute was ably represented by the president. Many other professional bodies were represented, and people across different sectors. A number of people who would be on the panel today also had the privilege of contributing. I had the privilege of working with the committee as well. There were three key areas that the committee was to look at, right? Look at fiscal governance, so what is the whole structure that could help the country to generate revenue responsibly, all right? And what are the sources of those revenue? How do we ensure that we increase the take, from the various sources, whether they are assets, whether they are taxes, and whether they are levies, but also in a way that facilitates economic growth and development. So those three key pillars were the umbrella for the work of the committee. Economic growth facilitation being very critical because of all of the complaints around ease of doing business and how we must drive foreign investment, and we must not discourage capital formation because we want to tax. And the committee works across at least 5 different subgroups. There are 80 members of that committee at least. And in some cases, some members also, have people supporting them, especially those that are representing, organizations. Now, the whole of the work of the committee was meant to generate at least 3 different outputs. One in the short term, which we call the quick wins, all right? And then we have the real critical reform. Some of the output from the quick wins, some of them, have eased into the tax-paying landscape in the past, like the withholding tax regulation, some palliative that, FIRS and a number of state tax authorities implemented in the past, like short-term palliative, but also a number of them that eventually dragged and, couldn't get passed earlier, like the emergency economic bill. But the main reform, the real output was a critical reform, which essentially means look at the entirety of the tax legislation and do a complete overhaul. So it is that phase that we are in with the recommendation for replacement and reenactment of all of our tax law, which is the subject of our conversation. Of course, the phase for implementation and monitoring and evaluation will then follow, subsequently. Now, I thought that background was necessary. Now, in terms of the conceptual framework, and pardon me, I will try as much as possible to be as fast because I know I have maybe roughly about 40 minutes to be able to do this, and it's quite a lot of issues to unpack. Right. So in terms of the output or the recommendation of the committee that has been quite a lot spoken about in the general public is the 4 tax bills that has now, that been submitted to the National Assembly for passage, and for which stakeholders' input and engagement are now currently being taken. So there are 4 tax reform bills. Now, there are other proposals, and if time permits, I will just touch briefly on all of those, because we also do have the economic stabilization bill. I know sometimes people, casually refer to the 4 tax bills as the economic stabilization bill. We actually do have the economic stabilization bill, which was meant to be the original emergency economic stabilization bill. And then we also do have proposed amendment to Constitution, as part of the framework for fiscal governance. But the core of the conversation is on this 4 tax bill. If time permits, we can touch briefly on those other issues. Now, so the 4 bills that we have, the first one is the one that we call the Nigerian tax bill, which is intended to repeal the entirety of the existing tax laws that we currently do have: companies income tax, personal income tax, VAT, and all of petroleum profit, and all of those tax legislations. It is called the Nigerian tax bill because the intention or the proposal is that all of these tax laws are consolidated into a single law, so that you won't have multiple sources for tax legislations. For those who are in practice and for those who are in business, you realize that beyond the fact that these laws, needs to be brought in line with modern reality, loopholes need to be covered, and all of that. When you have laws that have been in existence for quite a while, and some of the amendment that has happened over time, Finance Act, a number of them from Finance Act 2020, guideline here, regulations there, it becomes a little bit complicated for taxpayer to have a single pot of truth for the tax law. So the Nigerian tax bill, which will become the Nigerian Tax Act, if or when it eventually gets passed, will consolidate all of the tax laws. And what you essentially will have is different chapter for different tax types, different taxpayer. And then you have the second bill, which is the Nigerian Tax Administration Bill. which will eventually become the Nigerian Tax Admin Act when eventually passed. So this is the bill that is supposed to provide for the framework for administering all of these taxes in a way that there is coordination, there's simplification, there's consistency from registration to filing to assessment to payment procedure, penalty, and all of those. Joint framework for joint tax audit in a manner that the administration is simplified and is standardized across different types of taxes. One of the things that you will have seen is that if you read Personal Income Tax Act or you read VAT Act, you could have a completely different regime for penalty, for example. You know, this one could be charging 5,000 naira or 25,000 naira for first month, and then the other one could be charging a significantly higher number, and they're the same type of penalty, type of offenses. The same thing with registration, the same thing with requirement for the obligation for the taxpayer. So the Tax Admin Act, when passed, will help to focus on the administration part of it. And then we have the Nigerian Revenue Service Bill, or the Nigerian Revenue Service Establishment Bill, which will become the Nigerian Revenue Service Establishment Act. So this is the bill that will replace the current FIRS Establishment Act, with the proposal that even the name itself of FIRS is replaced by the Nigeria Revenue Service. There are a lot of proposal within this bill that is intended to position the new NRS as the tax agency for the federation, so that it can have powers and function that entitle you to really play that role as the revenue collecting agency for the federation, rather than just the federal government. And then we have the fourth one, which is the Joint Revenue Board. This is the bill that is seeking to establish, in replacement of the current Joint Tax Board, a new Joint Revenue Board. You will have seen, you know, consistency in the replacement of tax with revenue, whether it's Nigeria Revenue Service or Joint Revenue Board, and so on and so forth. So we'll have a new Joint Revenue Board, which essentially takes over and also expanded the current responsibilities of the JTB as we know it. But there are quite a lot of other innovations that, you know, we also sit under the Joint Revenue Board, like responsibility of the Tax Appeal Tribunal, which, you know, currently sits under the Federal Inland Revenue Service Establishment Act. You have the creation of the new Tax Ombudsman's Office, and, you know, and so on and so forth. So this is the key overview of the four bills. Now, I'll try to run through some of the content, and expectedly I will spend a lot more on the Nigerian tax bill, because that's where the real meat of the legislation. Of course, all of them also have fundamental reform. So, like I did mention, the Nigerian tax bill had consolidated all of the tax laws, and what you have is different chapter for different type of tax. There are 9 chapters, including the schedules, the general schedules. Secretary, please help us mute you. It's not talking, and I hope that's sound biting from the secretary, please. So we have 9 chapters, right? From the objective and application in chapter 1 to chapter 2, dealing with taxation of person, resident, non-resident, rate of tax, you know, for individuals and non-resident, development levy, and specialized business, and all of that. Then you have chapter 3 that deals with petroleum operation, like the carbon tax, PPT, production sharing contract, and all of that. And then the 4th chapter on double taxation. You have the 5th chapter on stamp duty. You have chapter 6, VAT, excise is chapter 7, tax incentive in chapter 8. And then you have other general provisions, you know, transfer pricing, business restructuring, and all of those in chapter 9. And then you have the various schedules. Schedules of capital allowances, priority sector, PIT rates, list of instruments that are dutiable, you know, and all of that. So that's how the Nigerian tax bill it's structured. Now, in terms of the content, again, there are the usual that charging section, who is liable to tax, and all of that, the typical thing. But I've just called out a couple of things that are important. Again, the idea is to expose us to what the bill says. The critique and the challenge and the input will come when we're then having the conversation. So generally, from even the definition of income that is taxable, the redefinition of it, the idea is these laws have to be modern, they have to be in tune with new reality. So if there are phrases and provisions that we have used in the past that are no longer, relevant for modern business structure, they're removed. Income that is taxable, for example, by that act says it's now limited to profit or gain that is accruing in or derived from. If you remember the old provision, it's not just those for accruing, derived from, brought into, or received in Nigeria. And so some of those elements that makes people wonder, what if the business activity didn't happen in Nigeria? Is it, an offense that, I earn profit elsewhere, I'm not a Nigerian company, and, I receive it while I am in Nigeria? It has nothing to do, no attribution to Nigeria whatsoever. Why are you taxing? So those kind of changes have happened. Of course, for Nigeria companies, tax will continue to be on a worldwide basis. So those kind of change had happened. Also, from a conceptual perspective, small businesses continue to be ring-fenced to enjoy the tax exemption that was introduced through the, very recently through the Finance Act of 2020. But the threshold for the revenue have now been raised, in fact, have been doubled to 50 million. So some of the key provisions in the Act: one, headline CIT rate is to reduce. It's currently 30. It's planned to reduce to 2025 from 2026. It's supposed to reduce to 25% rather from 2026. It will reduce to 27.5 in 2025, and then the year after to 25%. So you will see a direction for reduction in CIT rate, for example. You also have provisions that introduce development levy of 4% to then harmonize all the other profit-based taxes that we currently have: education tax, NASIMA, IT levy, and all of those. It's the same profit that you're taxing. So those are consolidated together, and the rates are 4%, with the possibility that in the future, this will also actually even reduce from a rate perspective. Then we also have quite a number of provisions that we think will be helpful for business. For example, provisions like minimum tax. It's no longer there, where you have percentages of turnover of net asset, and whether you are making profit or you are making losses, you still pay minimum tax. So those kind of provisions, were removed. Those cumbersome provisions relating to commencement, cessation of business that result in overlap and all that. So those ones were removed. Of course, there's a recognition of the BEPS initiative and global minimum tax. So there is a proposal for that a 15% minimum effective tax rate for multinationals and large companies in Nigeria be introduced, but this will be based on profits, right, rather than on net asset or just the top line like we used to have in the old law. We also now have the non-resident companies that are not non-resident companies that haven't created a permanent establishment in Nigeria will no longer be liable to tax in Nigeria just because the employee or the Nigerian employee creates a PE for them, right? As you will see some of the conversation later, the idea is to actually encourage employment of Nigerians and not let tax be a discouragement in a digitalized world where people can sit anywhere and get employment, right? Now you no longer have discriminatory provisions that says certain types of expenses will not be liable to tax. capital gain will only now be taxed, at the same income tax rate. Therefore, there is no longer segregation of capital expenses or the current expenses or revenue, expenses, so it will be deductible. However, if you do not pay the applicable taxes on them, so it's not free for all. There are always provisions to ensure that taxpayers do the right thing. So they will be claimable, but if you incur that expenses and applicable taxes or duties are not payable, then you haven't done the right thing. That would be a penalty for not doing the right thing, right? We also have provisions like unilateral tax relief for double taxation. In our extant law, it's Commonwealth tax relief. But now, if you earn profit abroad and it's repatriated through approved channels back to Nigeria, and you have evidence that you have paid taxes, you will claim tax credits to the proportion of the income that you have so repatriated. So those kind of provisions. So generally, you will see that taxes are being harmonized, rates are reducing, and then while there is incentive given to taxpayer for compliance, there are also some kind of provisions to penalize non-compliance or to discourage non-compliance. So we have those type of provision in the related to companies income tax. Some other provisions that touches on companies income tax, like I mentioned earlier, capital gains will no longer be taxed at a separate rate, different from income tax. The idea is to discourage aggressive tax planning, and all of that. But there are exceptions, right? So to say it will only be taxed if it's indeed a capital gain. Exceptions like if it's your own, your sole dwelling house, for example, even though it's an asset, that will not be liable to tax. Or cars that you are using for just for the personal run, up to 2 vehicles, you can have them disposed without the burden of taxes on it. So in the same way that gains are now liable, losses are also claimable. So there is no longer restriction on this is a capital loss, it's no longer claimable. We had the CGT exemption on shares introduced, existing in our law with a cap up to 100 million naira prior to now, but that cap has now been raised to 150 million. But gain on disposal of shares with proceeds of 150 million and below will still continue to enjoy that exemption, provided that the gain is about 10 million naira or so. Again, the idea is to not discourage what is happening from a capital market perspective. Provisions like what donations is deductible or what expenses in R&D is deductible. So those type of provisions were also reduced. So donations are now deductible even when they're capital in nature. If you remember, in the old legislation, there is this caveat if it's not capital in nature. Of course, there's still the need for sanity. So there's a cap of 10% for donation, 10% of PBT, and of course, for research and development, 5% of turnover, which is significant compared to what we used to have when it was almost like R&D is not to be allowed. Also, with businesses getting leverage and seeking finance, interest on loan are fully deductible once they are contractually contracted at arm's length with financial institutions. There is no restriction to what can be claimed. The only restriction now is if it's a related party transaction, it's a related party facility. So the 30% EBITDA rule will now apply only to related party. Of course, with the possibility that it can be claimed in the future over the next 5 years. We also have provisions that intend to sanitize the incentive regime. Pioneer has now been replaced with priority sector, sanitization of the EPZ, export processing zone, and free trade zone to ensure that companies that are operating within this zone are actually exports oriented. If you are located within the zone, and part of your sale is to custom territory, then you pay tax on the proportion of the business that is sold in the custom territory, provided that you don't sell more than 25%. If you sell more than 25% to custom territory, then you will be seen as an entity that is fully within the custom territory and pay CIT on 100% of your business. So just to ensure that there is no abuse within that space. So some provisions relating to individual employment income. If an individual is resident in Nigeria, will continue to be liable, or the duty of employment is duly or partly or wholly performed in Nigeria. Okay, and there is no tax paid in the foreign country. What this provision actually did is to revise the old conditions that make employment income liable to tax in Nigeria, particularly for non-residents. Okay, so that's so the provision has now been defined to say if your duty of employment is partly or wholly performed in Nigeria, those are the only conditions we're looking for. And to the extent that tax has not been paid, on that same income in the country of residence. For non-resident person, you've not been liable to tax in Nigeria just because of employment. Again, the idea is that there's a lot, if you see a number of things I've mentioned related to employment, the law were framed with the intention of making sure that we do not discourage employment of Nigerians by non-residents, particularly with the advent of digital services player and tech companies that are all around the world. The law also attempts to simplify all the relief and allowances, so everything essentially has been cleaned out. All right, so there are not, there's no retention of all those allowances for alimony, for CRA, and all of that. There is a current provision which as the bill gets discussed back and forth, we'll see what the final will be. But at least there's a provision for rent relief of lower of 200,000 or 20% of the actual rent paid. The tax table had been revised, right? Now the minimum wage earners supposed to be tax exempt at 0, and then you tax the balance progressively. Now, if you earn close to, 100 million naira and above, that's marginal, or 50 will get taxed at a slightly higher marginal tax rate of 25%. What you will notice is that the band has been widened a bit, even though the rate also has been raised. If you do the modeling, what you realize is that for most middle income individual, it's very unlikely that their taxes will increase. If you earn below 2 million naira a month, there's virtually no noticeable change. I think the change start happening something around 1.7 million or along that area, and it will be quite minimal until you get to the real HNI. So what you see is that there's exemption for the minimum wage earner. There's potential reduction if you are within the middle class, earning 500,000, a million naira, 1.5 million naira a month. The tax liability is likely going to reduce, and then for the real top guy, you will see marginal increase as the income level increases. Some provisions on the indirect taxes. There is an excise tax for telecom, for gaming, and operators of the black market of 5%. This itself has a clause that there will be a new executive order that will set it in motion. The idea here is a number of taxes that, particularly the telecom, and that's they're liable to charges, levies can be consolidated, and everything it's consolidated in that single excise tax. From a VAT perspective, quite a number of reform along this line as well. One of the things that has been dominant in what people were asking for from VAT is that it should be operated as a full scheme VAT, where you have input VAT deduction for whether it's on capital expenditure, whether it's on services and overhead, or like what we currently have. So that's provisions finally made it through to this bill. So there's now an expanded input VAT claim, so that you can claim your input VAT on capex, you can claim it on overhead, with also possibility for refund. There are, items that are considered to be essential items that have now been increased in zero rated or exempted. Items like rent, items like transport, like food, like healthcare, like education, including export services and IP, right? So, and intellectual property. So we have some exemptions. We have expansion in the input VAT scheme, but we also then have the proposal for an increase in the VAT rate. So it's the VAT rate by 2030 is expected to move to 15%, by just gradually moving in phases. By 2025, we move from to increase to 10 from the 7.5 we currently have, then by another 2.5 in 2018, and then by another 2.5 by 2030. One other important introduction that we're expecting if the bill was passed for VAT is the fiscalization, right? E-invoicing. There's a whole lot of conversation around automation, use of technology, digitalization. So fiscalization is in the works. Of course, small businesses will continue to enjoy the exemption with the increased revenue from 25 million, revenue threshold from 25 million to 50 million. Some key mention on the other three bills. I would just want one slide each. For the tax administration bill, I told you that this is the one that attempts to consolidate all the process of administering taxes from registration to filing to payment. So you have provisions relating to deployment of technology, e-filing, e-invoicing, fiscalization, harmonized taxpayer registration using NIN and RC number for company. So you have that provision in the tax admin bill. You also have provisions relating to EOI, exchange of information between tax authorities, right? You have provisions relating to the returns required by taxpayer. There's, overwhelming drive to increase tax transparency, including disclosure of aggressive tax planning schemes or special tax incentive that is not, enjoyed by all taxpayers. So you see a lot of demand for transparency and accountability. Disclosure requirements will be enhanced because the process is now a lot more simplified, and if it's tech-driven, and it's data-centric, the ability of Revenue Authority to do analytics on the number is then increased. So intelligence can be deployed. In this bill, there is provision for tax agents, people who support taxpayers for a fee to be accredited by the various Revenue Authority. There are provisions for refund in a more simpler, manner and quicker manner than the, not the current process where it's subject to after proper audit that goes on, indefinitely or for a long time. All right. There are provisions for monthly payment of taxes based on estimated profits by gas company. Also, if taxpayer want to dispute an assessment, whatever portion that is not disputed, right? There is provision for payment of certain percentage. So those and this procedures and guidelines are unified across the different tax authorities. So for standardization and for efficiency. Right, on the some quick things on the Joint Revenue Board. This is the one that is seeking to establish JRB, Joint Revenue Board, to replace the SY Joint Tax Board. So you have your traditional JTB function, but with expanded function with new membership, different governance framework for appointment of board members, and all of that. And it will be the JRB, we also help to harmonize, taxpayer ID and taxpayer information so that we can actually leverage data for tax administration. So it coordinates, and interfaces with the Nigerian Revenue Service, with the internal revenue services of state, with the local government revenue committees, and all of that. This bill is also where you now have the new Joint Tax Appeal Tribunal, rather, the provision for setting up of tax appeal tribunal, including extension of their jurisdiction to now cover laws that are made by houses of assembly in the various states to manage the dispute we currently have where the existing JTB is seen as an establishment at the federal level. Then one innovation, we've never had this in the country before, it's the introduction of the Office of the Tax Ombudsman. So this is supposed to be like taxpayer advocate for small taxpayers who may not be able to, who may have tax dispute and may not be able to afford professional services. I think on the continent we only have I think it's only in South Africa and I think Tanzania, that we have this office currently. I mentioned the guidelines, the accreditation of tax agents, for example. So in this bill, we have provisions relating to the guidelines for accrediting tax agents and all of that. So those are the kind of provisions you have in the Joint Revenue Board. And then the last bill, which is the Nigerian Revenue Service Bill, the one that is replacing the FRS Establishment Act. Again, everything relating to the function and the power of the Nigerian Revenue Service. So just reimagine the current FIRS with, a different focus, a country-wide focus. So they're able to harmonize revenue. You don't have multiple agencies that are seeking to collect taxes for the Federation. So we have provision relating to helping to harmonize collection, across the country. Provisions relating to the power of NRS to use technology, and to digitize. So I spoke to e-invoicing, fiscalization before. So there are enabling laws within the bill that will ensure that what they are doing is in line with the law. And the NRS also, because it's now the sole revenue collector for the Federation, also have responsibility for relating with government-owned enterprises, ministry, department, and agencies, work with the Office of the Accountant General for the Federation to have MDAs, comply with the provisions of the tax law, so that you don't have instances where taxes are deducted by these agencies of government and not remitted. Right? And of course, a lot of provisions around transparency and accountability, even by the NRS itself. The need for budget to be approved by the National Assembly, publication of their financial statements, publishing it online so that it can be accessible, by taxpayers and by Nigerians. So those are the kind of key provisions in addition to the general responsibility you will expect a tax or revenue administrator to have. So that's what we have. And then some of the provisions, what you have on the screen, you can see my slide, is the current state, as it were, when it comes to fiscal federalism in the country and revenue sharing. You know that whether it's oil or customs or companies income tax or VAT, they are collected centrally and they are shared, right? Now, particularly for VAT, and I'm touching on this because I think it's been one of the issues that has generated comments. The VAT that is collected by current FRS, right, goes into a VAT pool, and you know that federal government, state, and local government share in ratio 15-50 and 35%. There is a proposal that touched on this that has also generated comment. That proposal is, trying to drive equality and fairness, or equity, you know, and fairness. The current share by the state government, for example, this 50% is shared among all the tiers, all the states rather, in the federation, 20% on derivation, then 50 and 30% on equality and population, respectively. And if you remember what has happened with states like Rivers and a number of states, there have been agitation for, you know, fairness, particularly on the subject of derivation. Say it's 20% fair. So the proposal, one of which has generated quite a lot of public commentary, is that the derivation should increase, and then it's a reduction on the percentage that is shared on equality and population. So derivation is being proposed to move from 20 to 60%, and then population and equality to be 20-20, respectively. But I think one important thing that is usually not, you know, immediately visible to people when you say you increase derivation from 20 to 60% is that the intention is that with the zero rating, with the ability of the revenue agencies to be able to track, you know, consumption across all of the states, if we actually really apply the derivation principle, okay, and interpret derivation based on derivation, not based on what is currently done. What we currently do, essentially, it will not be perfect, but essentially just means where the VAT returns is filed. That's where you assume that they have been derived from. But that's not where the VAT is a consumption tax, right? So the new proposal, or the new bill, introduce provisions that ensure that you track based on where those services or goods are really consumed. So there is a fairer spread across the state. But I will, this just to explain the principle, not to take side. When we're doing the discussion, I think we can share view. I know I need to kind of wrap up shortly now. So in terms of the new direction, I mean, just a recap. We've seen what changes are coming from the CIT perspective. So it's a gradual shift from direct taxes to indirect tax. CIT rate is reducing. Personal income tax rate will be a lot more progressive. VAT is rising. Capital gains tax is, you know, unified with the company's income tax rate, and then you have those strategic provisions, you know, like tax ombudsman, excise duty, development levy, you know, to replace all of the other taxes, and a whole lot of other provisions. I won't. This is essentially more of a recap of what is spoken about. I won't labor you with trying to go through them one by one. And if you have heard as well, in addition to the provision that attempt to be raising the competition, there are also provisions that are also exciting. And I think those two balances are important to be understood, so that when we make commentaries and input, particularly in the public there, we have an idea of what we may likely benefit from or what we may likely suffer from if it is passed or if it is thrown out. So like the relief for SMEs, the increase in revenue, it's a huge one. Exemption of income tax, the fact that the middle class essentially is preserved, VAT exemption, you know, and all of that. Some of the provisions for vulnerable individual, all right, they're important. In fact, there's one of the provisions that I didn't mention, terminal benefit and compensation for loss of office. You have exemption, and the threshold has been increased to 50 million naira. You have compensation for loss of office, including compensation for libel and court cases, for example. I think up to the same 50 million naira. It's also exempt. The exemption on the VAT for essential item, you know, is there. The expansion of the input VAT claim is there. Zero rated of some services, faster, you know, VAT refund is there, right? And then on the personal income taxes, the real increase is at the really top level. You should earn at least 100 million naira or within that range and above to feel that your personal income taxes in a year will increase, you know, essentially. So that's where we have. And so if this bill is passed, we may, just get into that era where the number of taxes is actually reduced to single digit, as we were envisaging. You have one income tax, so that's the one that we cover, whether it's individual, you pay personal income tax. If it's company, you pay company's income tax. And so just one income tax. And then you have development levy, which is the second one that then harmonizes all your education tax, IT levy, NASEMA, and all of those taxes. And then you have VAT and excise duty and stamp duty. Okay, you could have custom, property taxes, and then the harmonized levy. All of those long lists, I think about 25 of them you have on the local governments. Everything, consolidated together. So there's a potential for simplification. There are definitely areas that, and you'll hear a number of them now from our discussant, a number of issues that a number of people have raised, but we think the focus is we could potentially have a data-driven, tech-enabled, tax system, potential for single digit, like I've said, and making the revenue authority to be empowered, and then not to have too many, number of them. So that's the direction. Fewer agency, fewer taxes, data centricity, shift from direct to indirect tax, simplicity, and potentially raise our tax to GDP ratio. I think the other point that I will just mention in this case is that I think when the consciousness for tax payment, is raised in this particular manner, there is the possibility that we may just be rewriting the social economic contracts, between the government and the people. People become more socially conscious, and the demand for accountability, especially when they are armed with information, when the revenue agencies are now demanded and obligated to publish financial statements and all of that. So if to raise tax morale, also the role of the tax ombudsman also means the tax authority can't just wake up one day and do anything. You have advocate that you can turn to. So I want to spend just 1 minute each to just talk to the other issue, because like I mentioned, the tax reform bill, the four are what is heavy in the public domain in terms of conversation. There are also at least two other group of proposals. One is the economic emergency bill. So this was meant to be the forerunner of the main four bills that we're doing now, because this was submitted way earlier last year. It was supposed to be the emergency economic stabilization bill, but it's now being passed much later. So you have provisions that tends to help us to look at our exports, some bit of incentives for export of services and export of goods and intellectual property. You have some provisions relating to employment that are intended to drive employment, all right, particularly for non-resident digital employers. All right, some of these have now been cascaded into the main law, but you also have provisions that were in the original emergency economics bill. Some provisions also around competitiveness and how we could drive investment in the gas sector. There was an employer tax relief that was meant to be for businesses that employ on an incremental basis rather than lay off during this crisis or during this economic turmoil, provided you're able to retain those staff for at least 3 years. Okay. Also relief for the wage award and the subsidies, and that the government was trying to introduce to ensure that tax doesn't just take away the benefit. Of course, student loan. I think we saw that being passed and eventually by the National Assembly. Some reform also around foreign exchange markets, and then cooperation with the states to suspend the implementation of the long list of taxes and levies, and a whole lot of that. So those were the provisions that you have in the economic emergency bill, or what we now call economic stabilization bill. We also have some recommendations for constitutional amendments, because there was part of the fiscal governance challenge touch on the provisions in the Constitution. So allocation and distribution of revenue, certain sections that to make sure that the proposals that we have in the bill is in tandem with the Constitution, because if any law conflicts with the Constitution, it will not avoid to the extent of that inconsistency. So the number of provisions like that, I think it was just important that I mentioned. Wrapping up, next step is that the bill is, the stakeholder engagement is ongoing, and that's part of this proposal. The president mentioned to us during the opening remark, we're doing this is that we wanted to be able to generate feedback from the members so that the tax faculty can help to coordinate that and present to the council, so that the council can then present that as a position paper by the institute. So in a way that members can have the sense that we contributed to what our institute, it's submitting. And hopefully the bill will get, will go through the lawmaking process by the National Assembly and it will be passed. Maybe because of my proximity to the work of the committee, I think there are quite a lot of positive in the bill that anyone will be so interested in making sure that we deal with whatever is a concern and we ensure that there's fairness wherever there's a push that something is not fair enough, but that at the end of the day, we don't throw away the baby with the bad water. Instead, we provide input that will lead to the passage. And once it is passed, part of the policy framework is that any new law before it becomes implemented in Nigeria should at least give minimum of 3 months to the taxpayer to get acquainted with the provision and get their system ready so that they can, they can become compliant. So, concluding thoughts, how do we cope going forward as individual? It's a lot to learn. You are essentially going to start reading and rewriting. We were told when we were writing ICAN, ignore tax. Well, we've done that at our own peril in those days. So now we can't ignore tax anymore. So let's get familiar with the content. I provided highlights. It's a lot more. All right. And the devil is always in the detail. So you want to be acquainted with the provision so you can do impact assessment maybe for your business or for individual. And don't focus, I always say, don't focus so much on the negatives when it comes to law. Those who do advisory services recognize that you focus on the positive. You comb every section for where the incentives are, rather than just getting fixated about one headline issue that everybody will be complaining about. And of course, it's our last round of opportunity to engage, so that whether it's from a sector, whether it's from an institute, or whether it's from the type of industry that you are representing or you operate in, we still have the last chance to be able to make that contribution. But that chance is really, really running out. So I'm hoping that this conversation today can provide a lot more perspective for us to be able to do that. So on that note, I will say thank you. I think I've taken even few minutes beyond the time that I'm supposed to take. But let me conclude on that note, and thank you for listening, and then we can open it up for the contributions from the discussants and then for the general members. So thank you so very much for listening.
Thank you, our lead presenter, sir, for that insightful and comprehensive presentation. Thank you, we appreciate you. Your paper has set the tone for our discussion today. And so we appreciate the effort you put into researching and analyzing the key aspects of the proposed tax reforms. So your presentation highlighted several critical issues, and these are indeed crucial concern that require careful consideration as we move towards the tax reform agenda. So I'm very sure our audience has taken a note of the complexities and challenges associated with the proposed reforms. So as we proceed with our discussion this morning, I encourage our panelists and audience members to build on the foundation laid by our lead paper presenter. So now we are going to proceed. I would like to introduce the first panelist who will provide our expert perspective on the tax reform bills. And she will be discussing the topic, corporate taxpayers, benefits and concerns by corporate taxpayers. She will be focused. She'll be focused on the corporate taxpayers. So what are the benefits and concerns by corporate taxpayers? And she is Mrs. Nike James, FCA, Partner Tax, KPMG. You are welcome, ma. You have 10 minutes. Please, can you work on your audio, please? It seems you are muted. We can't hear you. We still can't hear you, ma.
You need to work on your audio source.
Yes, yes, you are now. Yeah, you are now audible. No, still the same. Still the same.
You're good now.
Please confirm you can hear me.
We can hear you now.
Okay, you can hear me now. Okay, thank you very
Yes.
much. And I was saying thank you, everyone, and thank you, Yomi, for doing a good justice to that presentation. And I'll leverage on what you presented to be able to talk about the key benefits and issues that we have seen for corporate taxpayers, both from your presentation and from conversations people have had in reviewing the bill so far. So while we take, let me quickly go through some of the key benefits. I think the bill is largely focused on providing succor and incentives to our SMEs and to vulnerable people, which is very laudable. And it has brought in a lot of exemptions to the VAT, such that all essential products, to a large extent, they will be exempted from VAT. So those are top-notch benefits. And for our corporate entities, the larger entities, we also take note of the reduced corporate tax rate, which is currently 30%, but will go down to 27.5 next year, 25 year of assessment, and 25% by 2026. And then for ISMEs, now the threshold for an exemption from tax has now been raised from 25 million to 50 million, and also that your fixed asset must not exceed 250 million. Very well done. We see also in terms of the elimination of minimum tax for loss-making companies, which is desirable under the current scheme. We do know that if you make losses or you make less taxes than minimum tax, then 0.5% of your turnover will be taken as the minimum tax you have to pay, but that is gone off now, and we appreciate that. We also see that for capital gains tax, like you said, the threshold for exemption from capital gains on disposal of shares, which was hitherto 100 million in terms of disposal proceeds, has now been increased to 150 million, and that your gains must not exceed 10 million within any 12-month calendar period. And we think those are very laudable things, including the enhanced incentives that we see, like from the economic development tax incentive, which is the former pioneer status. There is the expanded priority sector list, and also expanded period whereby the exemption from tax exemption can be enjoyed by those entities. We've also seen in terms of like for bonds, we know that FGM bonds are exempt from tax. And after the demise of the bond exemption order in 2022, was only FGM bonds that was exempted from tax. There was a whole lot of noise. What about state government bonds too? And they're also a tier of government. And we see now that most state government bonds have been included in the exemption list. bonds that are exempted, which is beautiful. We've seen that there's been a lot of ambiguities for corporate taxpayers that has been removed from the law. So some incentives that were hitherto in other legislations, like for Pension Reform Act, whereby you see that it's pension funds and assets are exempted from tax in that provision, has now been brought back. We've also seen where clarifications are provided in this law, even for things that we already know, but we normally have maybe some kind of tussle with the tax authorities, at the end of the year, like what is doubtful debt, and FRS will say, oh, I'm not taking your accounting definition, you call this stage 3 impairment, no way, you explain it and say, no, unless you show me evidence, it's doubtful, the customer is dead, or you've gone to court, and all those things. But now we can see in the law that it says that even doubtful debts that are determined based on accounting provisions are tax deductible. So a whole lot of beautiful clarifications that has come in, and I think it would make the administration of taxes more efficient going forward and less contentious issues. Now, given all these benefits, we still see lingering concerns that are in the law. And I think there's one major one. I'll just quickly mention the other one so that I can have a little more time to talk about the major one. While we see that excise tax has been imposed on certain services now, telecom, lottery, and we do understand it's to curb certain, social behaviors, to discourage it. That is understandable. But when you then look at what telecom services are, and we ask ourselves, is it a luxury service or is it really like an essential service? So when you have an excise tax on it, invariably you are making that service, because the end users are likely going to take the brunt of that increase in tax. So we are making it more punitive in terms, at the end of the day, in terms of end users. So that is something that is a bit of a concern around it. There's also the issue in terms of our export processing zones and free trade zones. Yes, there's been a lot of abuse and economic distortions. I've also listened to fora when some of these things were explained. And why should a company, just because you are in the free trade zone, one is not in the free trade zone, you have different economic, outputs, and it can lead to the demise of a business and survival of another one. That is laudable, or that is understandable. But there's also issues about companies who have legitimately gone into these zones because of rationale, clear strategic rationale, that they have business models supporting it. And unwinding everything in one fell swoop will have significant implication on their business. In developed countries, if you have provisions of the law that would unwind issues that is taking time to take, they normally give a gestation period. So companies begin to have time to readjust in terms of their models, the way they are pricing, their issues, to be sure they can, because you can't throw out the bathwater, the baby with the bathwater. There are genuine businesses there that have taken advantage of what the free trade zone provisions are. And even though they will now not meet maybe the minimum threshold we have set now, that you must have 100% export to be fully tax exempt and everything, but they met the earlier provisions and they're genuine, and suddenly the very reason probably they went into the free trade zone, or part of the reasons, are now being they're now being disadvantaged. So we believe in this situation there must be a period of time set out for such companies to then to adjust, but not in a period of this year you are there, next year this comes in and you find yourself totally disadvantaged. I think that would be very punitive on those companies. And then last but not the least is on the minimum tax. Well, I think we appreciate the fact that loss-making companies are now exempt from minimum tax, and really any company that makes any tax you make now should be admissible for tax purposes. But the imposition of this minimum tax at the effective tax rate of 15% is essentially saying that companies who are in multinational groups, like you explained to us, and who have or who have turnover of 20 billion and above, will be subject to the minimum effective tax of 15%. That's number one. Number two, that section 57, like we know, there's the other section that defines what the effective tax rate is. And by the nature in which it is written, it talks about qualifying profits before tax. So essentially, you're applying the 15% on your qualifying profit before tax. And if the taxes you have paid during the period is not up to 15% of your qualifying profit before tax, you are then liable to minimum tax. And the question is, what is your qualifying profit before tax? Well, the same law does talk about, FRS will issue regulations to put further clarifications. As of today, since the law does not define it, we have to take it on face value. Qualifying before tax is qualifying PBT. And is that the same as PBT? If it is, we are saying we want to apply 15% effective tax on PBT of companies, and anybody that has a actual tax less than 15% of PBT will be liable to this minimum tax. I think that is an issue that needs to be looked at. The third one is also the provision still on minimum tax, and as it affects your subsidiaries, because Section 6 also talks about Nigerian companies who have non-resident subsidiaries. That means subsidiaries you have maybe outside of Nigeria in Africa, like a number of companies that have grown the African footprint, like in the banking industry. So that if you have those ones and those non-resident subsidiaries also do not pay up to 15% of their qualifying PBT in a year, then the parent company in Nigeria will be liable for the shortfall in that tax, and then the parent company will have to pay that as a top-up tax on its own tax in Nigeria. Let's put on the table that we do understand that these provisions come in through our implementation of the OECD Pillar 2 framework in terms of having a minimum effective tax rate for multinational entities. And the principles behind that is to ensure that companies pay at least a minimum amount of taxes in the countries in which they operate, and to discourage the profit shifting that comes from we having models that we shift your profits to low tax jurisdictions. So in each country you operate, you must pay a minimum amount of tax, and those are laudable things. But when we see the implementation of this provision in Nigeria under our own minimum tax, we see issues, and the three issues I'll quickly point out is first on that 15%. Like I said, our law talks about applying it on effective profit before tax, which is essentially your effective PBT. But when you look at the provisions of the OECD, it is not on the PBT per se, it is on your global income, which is your global anti-base erosion income. And it is defined around making adjustments to your financial income, whereby you would exclude, for instance, income that has already suffered tax at source, like dividend income, should not be part of your PBT. You would also exclude maybe expenses like fines and penalties because it's for wrongdoing. You would also exclude maybe incomes that are incomes from transactions with the related parties, because they want to avoid double counting. When I look at, a lot of those adjustments they say you make to your financial income to get your global income on which you apply the 15% non-tax, it is almost akin to you using an accessible profit like you have in the tax arena, and those accessible profits are to ensure that the items on which tax is eventually applied are things that are to be tax impacted. So it will not be appropriate for us to apply 15% on the accounting PBT. It must be on an adjusted PBT that is determined and defined so that it's just the right elements that are subjected to tax. And when you look at even certain industries like life insurance business, they don't even for tax purposes, they don't start with an adjusted profit. It simply lists out the exact incomes that are liable to tax, because in their own business, their insurance contract revenue, it belongs to the policy holders, and investment income on those revenue streams, the policy holders, is not the company. So the tax law lists out that you would only tax investment income from investing in shareholders' funds, and then commission fees and those kind of extraneous income that the company earns is the only items that are liable to tax. So for even those specialized businesses, you have to then define those particular revenue items, and the profits on those items should be what you're liable to tax. So that's the first issue, the use of the 15%. The second one is also on the threshold of 20 billion naira, which we have used. If you look at the OECD, it talks about applying that effective 15% effective tax rate on companies that have revenues, global revenues of at least 750 million euros. When you translate 20 billion naira that we have used into euros, it's less than or around 10 million euros, far less than what is used in the global arena. So we're not comparing likes with likes in a manner of speaking. And then go to the third issue, which is that we have also now brought in non-resident subsidiaries, whereby the Nigerian companies will be liable for the taxes of their non-resident entities that fall below this 15% threshold, and they have to do that as a top-up tax. While I take note that this provision about your non-resident subsidiaries is also in the OECD framework, but we should remember that that framework says it's applicable to companies, groups that have 750 million euros as their threshold. So I think it is extremely punitive currently if you decide to bring in non-resident entities when the threshold we're using here is just less, around 10 million euros. If you want to bring in non-residents in the letter and spirit of the OECD rules, then we should apply the 750 million euros too. So we know the kind of large, complex companies that will be caught by that. Well, if we don't use that, using a lower threshold and bringing in these companies, I think it's just a double whammy on a large corporate who have been paying taxes already and then putting further additional burdens on them. I don't know if I have more tax, but I think I'll send the major ones so I can afford to pause at this point. But I think that is the major issue that we need to address on this bill, in addition to all the laudable and good things that the bill stands for. Thank you.
Thank you, Ma. We really appreciate you. Thank you for sharing your expertise. We appreciate you, Ma. I would like to introduce the second discussant, in person of Mr. Kunle Oyetoyon, Deputy Managing Partner, Ijewere & Co. His area of focus is individual taxpayers. So what should be of interest or concern to individual taxpayers? Mr. Kunle Oyetoyon, you have the floor, sir. Please kindly unmute. We can't hear you, sir. You are muted.
All right. Thank you very much.
Yeah, we can hear you now.
Mr. President, I will stand up in protocol. I will speak to some of the amendments in the bills. I will start with the tax registration under Section 4 and 8. Every individual is expected to register with tax authority. So if any individual in Nigeria is not registered with tax authority, is not complying with the provision of the tax law, and it will be subject to appropriate penalty. It may also be denied contract from government agency. I will go to now, Yomi, in the course of presentation, also stated that capital gain on chargeable assets is not taxable at the rate of income tax. That is an increase in tax in the hand of the individual. Either to individual that derive capital gain have been subject to 10% capital gains tax. Now we will be talking about 25%, 27%. That is an increase in tax. That's the disadvantage to such individual. We look at that in Section 28, subsection 1V and 37, subsection 1 of the Nigerian tax bill. Now, the other thing we want to look at is the relief. The relief granted by this is grossly inadequate. The extra provision of personal income tax grant 20% or 21% of earned income plus 200,000 as the case may be. But that has been removed with this bill. That presupposes that the taxes that will be paid, particularly by high income earner, will be higher and their effective tax rate will be higher. If you look at the graduated rate that is being proposed, it gives room for lower income earner to pay lower tax. That is fine, but I believe strongly that personal allowances should also be looked into such that the tax incident on high income earner will be considered. Now, under section, the benefit in kind on official accommodation is restricted to annual rental value, less the rent paid by such individual, subject to 20% of gross income. This to me is to the advantage of the taxpayer because we have some officials that are giving official accommodation and the rental value may also be higher than the cash income of such individual. Under the discussion of section 21 of Nigerian tax bill, the law provides that if VAT is not paid on expenses or import duty is not paid on such expenses, it will be for tax purposes. I think the disadvantage of the individual in trade or business, because if you do not pay VAT on or pay import duty on your importation, then whatever expenses you are incur will be disallowed for tax purposes. And I think this is to ensure compliance with the tax provision by individual. Now, we'll move to Section 27 and first schedule. There is this new categorization of assets, qualifying assets under the capital allowances, and the uniformity of rates. The implication of this is that the qualified capital expenditure that has been incurred prior to this enactment of this bill will have to be aligned with the useful life of those assets. And I think every individual in business or trade should take note of this. The tax rate has been graduated from 0% to 5%. I've mentioned that individuals pay more tax, while individuals and medium we have less tax incidence. Tax payments, which the individual in trade should also watch out for, under Section 48 and 64, is when you are granted an extension and you don't fulfill the condition of such extension, penalty and interest may from the date as if such extension is not granted. What that means is that all individuals who are sought for extension must ensure that payment is made as agreed with the relevant tax authority. Tax return. The tax return has been specified for individual in trade or business. You are expected to prepare audited financial statement or an attestation. This may, implies that there are additional costs to be incurred by this trade or business. Now, failure to file this return within this specified period is 100,000 for the first month and 50,000 for each subsequent month. The incident of this penalty should be avoided by all individuals in trade and business. Under Section 29 of Nigerian tax bill, there is this presumptive tax where your rent cannot be reviewed to ask the tax that should be paid, but where it is impracticable for an individual in business to determine his tax, the law empowers the relevant tax authority to use presumptive tax, which is regulated by the minister. What my advice to individuals in trade on business on this is that they must prepare record of their transaction in such a way that this provision will not be applied, because it could also result in higher tax than if the appropriate record of the taxable person is prepared. Now, under Section 157 and 163, Nigerian tax bill, tax is imposed on, excise duty is imposed on telecommunication, gaming, lottery, and the likes. What this means is that individuals who are consuming services of these telecommunication companies will have to pay in excise duty. That cost for individuals and persons that are subject to tax in Nigeria. And in this era of where the income is so low, I think we need to look at how to create an incentive for lower income earners in such a way that they will not be exposed to this excise duty. Now, you also have revision of assessment in case of objection under Section 40, the law allows that the tax authority is obligated to respond to the objection to an assessment within 90 days of receipt of this objection. This was not in the extant law. You have a situation where the tax authority, when conducting tax audit, will say, oh, your objection have to be within 30 days. But their response may be delayed to eternity. With this provision, they are obligated to respond to the objection within 90 days. But the law fails to state what is the consequence of failure to adhere to this provision. Offenses and penalty. There are various penalties attached to offenses under the bills, and this has been increased from what we used to have. So my advice to all individuals in trade or business or in employment is that they must comply with the provision of the bills such that they can avoid the imposition of penalty and interest. Now, you also have under Section 32, tax agent and representation. A taxpayer may be represented by an accredited agent. So, individuals and persons in Nigeria should ensure that whoever is representing them should be accredited by the service. This will discourage quack consultancy that we have in the current dispensation. Now, we also have the tax ombuds under Section 35 to 48 and third schedule of Nigerian Revenue Board 2024. This provision, if enacted, will enable individuals who are not capable to engage in this legal representation access the services of the ombuds to ensure that their complaints are attended to. Then you also have advanced ruling under Section 70 and 73 of Nigerian Tax Administration Bill. Now, this will also be exploited by individuals to ensure that transactions they want to enter into, they obtain advanced ruling that will be binding on the relevant tax authority before they engage in such transaction. Now, the individuals in Nigeria should also be aware there is no hiding place for them when it comes to tax compliance, because under Section 14 of Nigerian Tax Administration Bill, you have exchange of information. And the law even provides that where a relevant tax authority is reviewing the record of a person, it also call the other relevant tax authority if we observe non-compliance in the course of the and you may call for joint audit. So the possibility of non-compliance is being removed with the tax bills. Now, I have tax computation here, but I cannot display that. All in law, what we are saying is that these bills have good system. They will develop tax practice and administration in Nigeria, and is moving us very close to develop tax jurisdiction. The position of the taxpayer is that the government will advocate full compliance with this law by ensuring that judicial spending is done with the revenue generated by these taxes. And on that note, I will just pause because of time here. Thank you very much.
Thank you, sir. Thank you for the thought-provoking comments. We appreciate you. Now, I will call on the third discussants to also do justice to our discussion, and that is Mr. Nasir Sabo Idris. His area of focus shall be state and subnationals. That is our local government areas. So what are the concerns and benefits impacting states and subnationals? what are the concerns and benefits impacting states and local governments? Thank you, Mr. Nasir Sabo Idris. You have the floor, sir. You are muted, sir. Kindly unmute yourself. Thank you,
sorry.
sir.
Thank you very much. Thank you very much, Mr. President. Permit me to stand on existing protocols to offer my insights and the thoughts into the new Nigerian tax bill, proposed Nigerian tax bills. Can you hear me, Doctor?
Yes, I can hear you clearly.
Okay, okay. For us, first and foremost, we have to look at the relevant sections that provided for revenue collection for the subnationals. If you look at the taxes and levies approved list for Collection Act 1998 as amended 2015, the number of taxes collectible by the 3 tiers of government in Nigeria are about 64 in number. And with the new proposal by the by this bill, the number of taxes has been reduced from that 64 to 8. That is a single-digit number. Previously, 17 number of taxes were under the authority of the federal government, that's the FIRS, while 25 number of taxes are under the jurisdiction of the state governments. 22 number of taxes are under the jurisdiction of the local governments. By reducing the number of taxes from 64, the number of taxes, fees, and levies collectible by the 3 tiers of government from 64 to 8, some states have been raising their concerns that the number of taxes, levies, and fees they are supposed to collect has been reduced, thereby affecting the amount of taxes to be generated by these states and local governments. The number of taxes that are now to be collectible by the 3 tiers of government under the new tax law, that's the proposed tax law, will be 8 in number. There is income tax is still there, value-added tax, excise tax, stamp duties, development levy. Others include custom duties, property tax to be collected by state in collaboration with local governments. Then we have harmonized levy. This is for local government. So we have 8 in number. Out of these 8, if you look at it, you will see that the subnationals, the state and local governments will still administer personal income tax, stamp duties, property tax, and harmonized levy. The harmonized levy is to be administered by the local government. So still those who are raising concerns about the reduction in the number of taxes, if you look at it, the major taxes that generate more revenue for the state are still there. The personal income tax, that is the income tax now for individuals and registered business names, registered business names are still there. It's still there. Stamp duties still there. Property tax still there. Harmonized levy, which is newly introduced now for local government. So if you look at the best practices in the world now, the developed world have tried to reduce the number of taxes collectible so that taxpayers will not be faced with a various number of taxes to be paid, and also various tax authorities. So by consolidating the number of taxes, the law has streamlined, the proposed bill has streamlined the number of taxes, thereby increasing the efficiency in their collection. Also, if you look at the new rates proposed for personal income tax. Hello, do you hear me? Also, if you look at the new rates proposed for personal income tax, you will see that it is progressive in nature. The progressive nature of the personal income tax is expected to offset any loss that is envisaged by the exemptions granted to the low-income earners. Also, some of the concerns that have been raised by so many states and local governments, we have reducing the number of taxes, as I just explained. There is the elimination of consumption taxes administered by some states. So many states in the Federation are now collecting what is known as consumption taxes. Some of them are making a large chunk of collection from administering these consumption taxes. The newly proposed bill has eliminated that. So some states are feeling that by eliminating the consumption taxes, that will lead to a reduction in their revenue. However, I feel that with the introduction of the fiscalization of the VAT through the use of technology and the real-time monitoring of VAT filing by tax authorities, there will be increase in the VAT. Also, if you consider the percentage increase in the value-added tax, this will lead to increase in the amount of value-added tax collected, leading to more share of value-added tax to the states. I think that will compensate for the loss of the consumption tax, for eliminating the consumption tax which was being collected by some states. Also, one of the major contentious issues in the proposed bill is Section 77 of the bill. If you look at it, you will see that the VAT sharing formula has been changed from what it used to be to a new formula. This is also of great concern to states because some states are pointing out that the removal of some of the criteria, or rather the reduction of some of the percentage attached to population and equality will lead to loss of some shares for these states. The revenue sharing formula, that's the old one. The federal government goes with 15%, state government shares 50% among themselves, local government shares 35%. And 20%, the sharing among the subnationals, 20% is based on derivation, 50% is based on equality, while 30% is based on population. If you look at the new submission by the bill, the formula has been changed from the vertical sharing is federal government 10%, state government 55%, and the local government 35%. And the sharing formula among the subnationals has changed from what it used to be. Now 60% of the 50% to be shared among the state goes is based on derivation principle. 60% is based on derivation principle, while 20% is now based on population, 20% is based on equality. Some states are raising concern that this new formula will lead to reduction in the share of value-added tax. Also, some are raising concerns that there need the number of population in that area and the land mass. So, because most of those states that have higher population needs more resources to be able to deliver to the people. Some are feeling that what is coming to them is not up to their need because of the large population. So that is why the challenge on the reduction of the principle of sharing population from 30% to 20%, equality has been reduced from 50% to 20%, which means some states will get less than their need if you consider their population. Also, the issue of equality among states has been reduced from 50% to 20%. This is one of the major concerns of some of the subnationals. However, my thoughts on that is that with the fiscalization of the value-added tax and also the increase in the percentage of the value-added tax will lead to more value-added tax collected all over the country, which will lead to more shares to the subnationals. Also, if you look at the proposal, you will see that 5% has been set aside. The 5% out of the ones going to state. 50, instead of sharing the whole 55%, 5% is going to be set aside to compensate for any loss by any states. As explained by the chairman of the committee, that 5% will be held in an account. Any state that did not receive up to what it should have received under the old sharing arrangement, that 5% will be used to compensate such states. I think this will go a long way in addressing the imbalance likely to be brought about by the change in the value-added tax sharing formula. Also, some of the benefits derivable from the new tax bills is harmonization of the process of collection. The process of collection of tax will further be harmonized among the 3 tiers of government. Also, the approach by reducing the number of taxes, fees, and levies collectible, simplicity has been brought into the system. Also, there is tax certainty. Instead of duly dealing with so many number of taxes, there are so many taxes that are nuisance taxes. Some of them have not been able to be collected efficiently. So by reducing the number, efficiency has been brought. Also, there is tax certainty. Also, modernization. If you look at the way some of our subnational revenue agencies are operating, there is need for them to modernize by incorporating technological input into the national bill that will make the subnationals to embrace technology in the process of assessment and of collection of taxes, which will lead to more revenue generation for the subnationals. Also, there is the fiscal federalism. That is the issues, the disadvantages that are associated with fiscal federalism are also there in the bill. Because anywhere you have fiscal federalism, you are bound to have some inequality because you are de-emphasizing the equality principle and now emphasizing on derivation. However, I believe that with more hard work on the part of the governors of and the local government chairman, there will be there will be improved economic activities. So governors and local governments should try to bring in more investors to enhance the economic activities in the state, because internally generated revenue is a function of economic activities in the state. Also, by proposing for the Joint Revenue Board, there will be more synergy.
Dear participants, we are sorry for the interruption. Yes. Yes, you are back, sir. Kindly unmute yourself. Honorable Nasiru Muhammad. You are welcome back, sir. You are muted, please. Honorable sir, you are back on the call. Please unmute yourself. So I think we will move to the next speaker. The Honorable is having network each. So
sorry, madam. Honorable
back,
Nasir is a member of council, different from the chairman of Jigawa State Board of Metal
Oh,
Revenue.
I'm very, very sorry, sir. Very sorry, sir. Okay, Mr. Nasir Sabo Idris, sorry, he has a network each. So we want to continue with the next discussants, Mr. Halbert Folorunsho. Mr. Nasir will come back during the question and answer time. So Mr. Halbert Folorunsho, your area of focus will be implementation challenges and concerns by government-owned enterprises and revenue-generating agencies. Implementation challenges and concerns by government-owned enterprises and revenue-generating agencies. Mr. Albert Folorunsho, Managing Partner, Christine Pedabu. You have the floor, sir.
Thank you very much, Madam Adedokun. Good afternoon, Mr. President, my professional colleagues, ladies and gentlemen. It is a great pleasure to be here to have this conversation, and it is trite in the sense that this is more than expected from our institute. And since we have our members here, we'll go a little bit into some details, even though I have around 10 minutes. I will try and rush through what you have limited my area of focus on. I don't know whether I can share. Maybe I can share quickly.
Yes, you can share. You can share your screen, sir.
Okay, just to make the presentation faster, I would like to share because of the area that you have asked me to speak to. The first one will be speaking to the issue around implementation of the VAT. I know the last speaker spoke about the grudge around the current sharing or the proposed sharing formula, and essentially to speak to that, we'll talk about the fiscalization of the suppliers of VAT, which means that we expect that the FRS will deploy technology, electronic fiscal devices such as the electronic tax register, and software solution or communication that will help to enhance the collection of the VAT revenue, as well as ensure that details as to where this VAT have been consumed, I mean, the services or goods have been consumed, are made available, because that is the essence, that is what has been proposed in the bill. Of course, I'm not going to speak to the issue of the expanded list. Let me just run to an area which I believe will speak to how we expect the tax authority to respond to this. Of course, we have talked about the sharing formula, as mentioned by the last speaker. The question is, how do we determine how will the authority, how will the authority be able to ascertain how much VAT has been generated from each state, and how, on the basis of which we can now apply this derivation formula. Of course, the current position is what we have on the screen. At the start, the collection cost is 4%, 2% for custom. Then the federal government takes 15%, the state 50%, and the local government 35%. But the current sharing, like he said, is 20% on derivation, 50% equally, and 30% on population. Okay, but what is being proposed, if you look at the way it's being done now, which is what we have, is that it is based on where the tax is being collected. And that's why I just put a formula here to show how it is calculated. The Lagos attribution divided by the total base, multiplied by the 20%, which is available on the basis of derivation. The bulk of the tax actually comes from imports and non-resident. Those now will be broken down further under the new dispensation, because presently it goes direct into the pool and nobody really take benefit for that. But now you will know who the importer. If the importer is based in Kano and they are the one paying the VAT, that will be accounted for them. If the non-resident renders a service to somebody in Jigawa State, that because the Jigawa State resident person is the one paying, that will be attributed to them. And that is what is in the proposed bill. So what we expect to see under the new proposal is federal government 10, state 55, and local government 35. But the focus really is this 60% derivation, which has been put forward. How will it impact on how much is going to each state? And I have always said that a number of us have not taken time to look at the details of what is in the bill as far as this derivation is concerned, because what we presently have is a situation where 72% of the VAT collected goes to about 4 states, Lagos, Rivers, FCT, and I think FCT and Oyo State. Yes. So, but with the derivation properly applied on the basis of 60%, what we expect to see is a situation where you have goods. If we are dealing with goods, the output VAT on the production, and then you have the input. The input can either be on locally purchased or imported. so that you'll be able to ascertain how much is attributed to a specific state. So if this good is produced in Lagos, for example, the VAT attributable to state A is what we have there as XYZ. Then the goods are now moved to, let's say, Jigawa State, okay? A merchant who is a distributor in Jigawa State. We have an output VAT on those goods as sold by the state B. Then you deduct the one from state A before you ascertain how much is attributable to state B, which will be the amount on the basis of which derivation will be applied, and so on and so forth. I also brought the one around, somebody raised a question around zero rated. I believe that that will be system calculated such that attribution will be made on a memorandum nominal basis, so that even where states are selling zero rated goods, there will still be attribution on the basis of the activity that has taken place in that state. So I just wanted to point out this. Then going back to the paper, again, I will just share another document so that I can run through again quickly. I believe somebody is watching time for me now. Okay, share. No, not this, sorry. One second, please. But it has to do with the implementation challenges that I'm supposed to speak to, which is what I've already mentioned as far as the issue of fiscalization is concerned. We will have the challenges we will have is where we have different payment methods, people paying in cash, credit card, vouchers, multi-channel retailing, particularly when it comes to VAT again. Multi-channel retailing transaction can be created and at any time, anywhere, mostly with different systems, such as POS, through the retailers, websites, maps, and all that. It is uncertain that the tax authorities have the infrastructure as we speak, or technology to integrate all of these channels, multiple channels into generation. We also have getting retailers to adopt the VAT fiscalization is going to be a problem, and we believe that it's an area that FRS will have a lot to do. Okay, it will pose, as people will resist the installation of technology or device into their system. Some have even said, yes, if you want to install any device, I don't have a current or sustained internet. You need to come and pay for my internet and all that. So those are some of the challenges that will come when it comes to the VAT. Then, of course, we also have the issue around data security. Data security is one of the challenges Nigeria is currently facing in the advent of technological developments in this country. The importance of securing taxpayers' information cannot be overemphasized with increasing reliance on digital system or revenue collection. In recent years, we have seen there has been several experiences of cyber attack targeting several institutions, including government agencies, indicating serious challenge for data security. I believe that that is an area that the tax authorities will need to focus. We have weak cybersecurity measures. The risk of hacking or data breaches are going to be significant and is present, and we have present risk around that in most government institutions. To avoid loss of public trust in the collection agencies, financial fraud, and non-compliant by taxpayers, collecting agencies must put proper measures in place to guarantee the security of data, safety of business owners. Then we also have the issue around touts and other illegal revenue collection agencies. The touts and unauthorized revenue collection agents undermines the official processes and creates a lot of confusion all over the place for businesses and individuals. Some of this leads to double taxation, harassment of taxpayers. The failure to address this issue could also erode public confidence in the implementation of the bill, in the formal revenue collection system, because we are saying that we want to harmonize, and we will expect that all these nuance irritating taxes are reduced or removed totally. And for that to work, most of the things we have proposed must be implemented to the letter. And That is a major challenge. Then we have challenges of other government agencies. We have the fact that some taxes are going to be subsumed. We have challenges relating to NITDA, Nigeria Information Technology Tax, the National Tax, the Police Trust Fund, which is supposed to have expired right now. We have the education tax majorly. And so we have multiple agencies like NITDA raising question as to what happens to them. Naseni and others have contributed to increase the number of government agencies collecting taxes and levies, which this bill is trying to reduce. So this has caused inefficiency in tax administration and implementation of several government policies. So some of the inefficiencies due to this creating taxes for everything that requires special attention is that we have overlapping functions. The functions overlaps. We have more or less double taxation. You already paid your corporate tax. You are paying additional tax for education, limited interagency coordination, further leading to inefficiencies. So these challenges will be addressed based on this law, this bill. If it is passed, since we're going to have a unified rate for all levies and at a central position, the introduction of the development levy at 4% will eliminate all of those education, NIDA, National, and PTF. But of course, that does not mean that these agencies will not exist. They will still continue to exist, and we expect that if there are no provisions in their law, as we have seen in one or two of them, for appropriation by the federal government, by the National Assembly, such adjustment must be made so that proper appropriation or direct appropriation can be made for these agencies of government. So these are the major challenges I see as far as this provision of the law is concerned. We also have the issue around custom and NIMASA. Yes, the law have not subsumed any agency. The law have not said that the Nigeria Revenue Service will take over the responsibility. What the focus has been that possibility of ensuring synchronization of collection so that there can be a central collection point, not administration per se. And I believe that's the only way, a good way to start, even though we know that in other climes, we have all those agencies are subsumed as one, but that is not the intention immediately. But there has to be a synchronization of collection so that accountability and utilizations can be properly monitored. These are the issues I would like to raise on these aspects. Thank you very much. And I'll be available to take questions on any aspect. And I also have comments on some of the points that have been raised by other panelists. Thank you.
Thank you for the presentation, sir. We really appreciate you. We thank the lead speaker and the panelists for doing justice to the topic. Now we are now in the question and answer time. If you want to ask question, please kindly send your question to the Q&A box, please. Questions on the chat may not be taken. So if you have questions for the panelists or for the lead paper or lead speaker, you can kindly send to the Q&A box. Send your questions there. Already we have some questions, and I'll be taking them one after the other. The first question we have here is, for organizations that deal some products that are not VATable, will the operating expense be VATed for the expense to be allowed? Mr. Albert Folorunsho would like to answer this question.
Yes, I've responded to some of those questions. So definitely, if your product is zero rated, as long as you consume any VATable item, you will incur VAT, and you will be eligible, not that it will be expense, you'll be eligible to claim refund. So you will have a zero output VAT and have so much as your input VAT, which you have suffered on your assets, on your expenses, and on your goods and services. So you'll be in a refund position and you can claim those refunds with limited audit exercise as already specified in the bill.
Thank you, sir, for the answer. Then we have another one here. Please give us an example on that zero-rated items like agriculture products.
Okay, so in the presentation I just put up, I gave an example of maybe a yam in Benue, for example. 1 second. Oh, sorry, this is not it. Sorry. Okay, so let's take yam, for example. You are a yam merchant, okay, and you have you are a distributor of yam based in Benue. Maybe you supply those yam to a factory in Kano that deals in yam flour and all that. So the yam you are buying from the local people, they are probably under the baseline of 50 million turnover. So definitely they will not be required to even file VAT returns, and they are exempt. The product again is exempt. So the only possibility of having record of that in the tax sharing basis is when you issue invoice, and those are the major concerns that have been raised, particularly by some states. When you issue invoice to sell those products, whether it is VAT exempt or not, issuing invoice means that it will come into the purview of the tax authority, and record can be taken of it, even where there is need to insert a nominal VAT for the purpose of attribution or not. I mean, that is still required, but as long as you are not within that bracket, or the product is are those retail peasant farmer activity, they will not be in the reckoning for attribution. That's my personal view.
All right, thank you, sir. Before we move on to the next question, the IPP, Dr. Innocent Okosa, FCA, raised his hand. So I'd like you to talk, sir.
All right, thank you, Dr. Adedoku.
Yes, sir.
I just want any of the panelists, possibly Mr. Lugbendu, to speak on the position of the professional bodies, those who engage in tax practice, because Section 35 makes reference to a situation where you use a consultant. How does that link to the three professions currently that engage in tax practice? I think our audience will be interested in such information. So I don't know whether Mr. Lumulu can speak to that. Thank you.
Thank you, sir. Mr. Lugbendu, sir. Okay.
Yeah, thanks so much. By IPP. Yeah, so that provisionally it's to help us sanitize the practice of professional tax practice. So when you have agents who are hired by taxpayers, the tax consultants who are hired by taxpayers, and helping them to comply with their tax responsibility, those type of service needs to be held to a standard of practice. And currently, because such regulation doesn't currently exist, or at least not effective, so the bill now had made provision to ensure that the relevant tax authorities are charged with the power to be able to do that. Now, with respect to this bill, there's recognition of our institute, ICAN, and its member as having the requisite skill. Obviously, in terms of the operational modalities, it will still be required that by the time the guidelines is being issued by the NRS and the JRB, we also need to ensure that we stay close to the conversation so that the institute is not disenfranchised or it's not disadvantaged. So it's at that level of the operational modalities that we will say some work will still need to be done when this is passed. If you noted when I was having my presentation, the NRB and the NRS will, have some responsibility with respect to providing the mechanisms and the guidelines, and all of that. So as far as the law is currently constituted, there is no disenfranchisement or disadvantage to members of ICAN in terms of their, practice of the profession. But we need to be sure, we need to ensure that those conversations and engagements are seen through, so that the appropriate notice is taken of the rights of the members of the institute to practice their profession. So I hope that suffices, Mr. President.
Thank you, sir. We appreciate you. The next question. This will be directed to Honorable Nasir Zabo. He's back on the call right now. And I want to give you opportunity. I want to give you opportunity, just 2 minutes, to round up with your discussion, and then answer this question that I will throw to you now. Money collected on behalf of subnationals, will it be shared to the whole federation, since the bill is proposing a centralized collection? Money collected on behalf of subnationals, will it be shared to the whole federation, since the bill is proposing a centralized collection? Thank you, sir. Go on, you have the floor.
Yes, thank you very much. The bill is proposing a centralized collection. This harmonized collection is just to enhance efficiency of the revenue collection. However, the amount generated is going to be shared among the subnationals, all the subnationals, based on the specified sharing formula. For example, if you look at the VAT sharing formula that is proposed by the bill, you can see that the VAT collection, having eliminated the consumption taxes administered by some states, now it is only value-added tax now that is left to be collected centrally. However, that value-added tax that is collected centrally is going to be shared based on the formula proposed by the new bill, which is federal government will take 10%, state government will share 55%, while local government shares 35%. I think that answers the questions.
Okay.
Dr. Adelokun, I don't know if I can.
Okay.
Okay. All right. Sorry. Continue, sir.
Yes.
Continue, sir.
Mr. Yemi, I cannot hear you.
Oh, okay. I paused for you. I was thinking you were still making your comment. Have you landed, sir?
You said? Hello.
Have you made your comments?
Yes, no, I'm not done. So am I free to carry on with my presentations?
Yes, go on.
Yes.
Okay, as I was saying, those subnationals that are concerned about the reduction in their share as a result of the change in the revenue sharing formula should note that there are new initiatives brought about by the proposed bill. For example, if you look at the fiscalization of the value-added tax returns will lead to blockage in leakages thereby improving the overall value-added tax collection nationwide. By so doing, the share going to different subnationals will increase. Also, if you look at it, the value-added tax percentage has been increased. The gradual increase from 10% up to 15%. So by this increase also, that automatically increases the share of value-added tax that is going to the states. Also, one good thing about the new sharing formula that I think should be able to calm some nerves is the issue of zero-rated. It is recommended that zero-rated items should also be captured by the derivation principle. I think this one will be able to calm some nerves on the complaints about the new sharing formula. Also, there's the issue I mentioned of joint revenue board, which will enhance harmonization, will enhance synergy among the different agencies, revenue agencies of the subnationals. Also, there is an area that is very interesting that is now delegates its authority to another tax authority to collect taxes on its behalf. This one will go a long way in addressing the issue of inefficiency of some tax authorities of some subnationals, which means subnational tax authorities can now rely on the federal government, that's the National Revenue Service, to be able to assist them in the collection of their taxes, because the federal government, the Federal Revenue Service is in a better position, is more equipped. So now, by allowing for delegation of authority, I think the subnationals will benefit from this initiative. Also, if you look at it, the increase in the rate of the personal income tax is expected to compensate for the loss of revenue envisaged by some subnationals as a result of the reduction of the number of taxes, levies, and fees collectible by the subnationals. Because if you harness the relevant technology in the collection of the personal income tax, I think with the increase in the percentage, that will lead to more revenue generation on the part of the subnationals. Also, the stamp duty is still there. Property tax is still there, harmonized levy. This harmonized levy that introduced to be administered by local governments, you see, according to the levies and the act, taxes and levies act, there are about 22 number of taxes collectible by local government now. These taxes has been now harmonized into what is called harmonized levy. This will make the subnationals, especially the local government, to concentrate on a single tax, thereby simplifying the process of tax collection for the local government. Also, the bill has encouraged autonomy for the local government as part of the subnationals, which I think will go a long way in making the local governments to concentrate on their main functions, which is the provision of services to the locals. So the autonomy granted the part of the local government and the advantages brought about by the fiscal federalism element contained in the proposed bill will go a long way in encouraging efficiency in the process of administering the newly proposed taxes for all the tiers of government. Thank you very much.
Thank you. Thank you so much. We really appreciate you, sir. I want to move to the next question, which will be directed to Mrs. Nika James.
Dr. Dedokun, just before you go, if I can just take a minute to clarify a number of direct questions I've gotten on the response I gave with respect to the tax agent. So a number of people have reached out to ask whether the bill is seeking to make use of tax consultant or tax agent mandatory. So that's not so. Taxpayer will still have the right to file their tax returns. So the provision with respect to accreditation of tax agents only apply for instances where a taxpayer chooses to use an advisor or a tax agent or a consultant. And the idea is to ensure that the practice is sanitized and you do not have quacks. So agents, activities and services will be monitored and supervised by the relevant tax authorities, such that if there are infractions, detected with those returns and the borders on professional negligence or whatever infraction they might be, appropriate sanctions can be taken against those tax agents, including possibility of banning those individual or any other applicable sanction that may be necessary. So I thought I should just clarify that.
Thank you, Mr. Chairman, sir, for the clarification. Now we have a question here. How has this reform considered the burden of taxation and ease of doing business in Nigeria? Do these proposals make Nigeria more business friendly? So I'd like to direct this question to Mrs. Nika James. Can you unmute yourself, ma?
Okay. Hello, please confirm you can hear me.
Yes, clearly, we can hear you.
Okay, very good. And thanks for that question. Yes, I think in terms of the ease of doing business, we can argue that we've actually consolidated the number of taxes that we have. We've simplified the process and put them all in a simple tax law so as to make the administration and compliance easy on taxpayers. So from an ease of doing business, you have to look at it both in terms of locally, internally, and from the perspective of global players who want to come into the country to do business. I think for a whole lot of people locally, in terms of the ease, it should actually ease and streamline the process. So many taxes have been compressed, CGT and CIT brought together, even though there's a harmonized rate, but there are incentives, the exemptions, there are simplicities all around. So locally, I think so. In terms of global players coming into the tax net, I believe also in terms of majority of the changes that we have seen that has come into those changes should actually promote those incentives. However, some of the loose areas that still needs to be clarified, particularly the application, for instance, for corporate players in terms of the minimum tax is key. It's key so that it also doesn't discourage, disincentivize, investment in that category. But I think overall, I'll feel comfortable to surmise that says that the simplicity, the consolidation, the incentives, and what we have in the totality of the bill actually eases, it promotes the ease of doing business. Thank you.
Thank you for the answer provided. Then we have another question here. And the question says, Nigerians are facing real pain from the impact of the economic reforms undertaken by the government. Why is the government's focus on tax reforms at this time? Nigerians are facing real pains from the impact of the economic reforms undertaken by the government. Why is the government focused on tax reforms at this time? Mr. Chairman, sir, will you answer this question?
Yes. when I hear real pain, I listened the second time to be sure that it was a real pain you actually called, just to be sure of you know what I'm hearing, because we've also had different usage. But that's just, I mean, that's on a lighter note. Quite honestly, the challenges that citizens are faced with, they are real. It cuts across every sector, and it cuts across every income bracket and strata. So I think that needs to be acknowledged. And we know why those things, you know, are happening. All of the reforms that have been embarked upon, they actually went so very to the root of, you know, economic existence and life wire, and so the impact is what is here now. Thankfully, the question isn't so much about the reform. I think those specific actions that have been taken, that have been taken. I think the question is around whether, you know, this tax reform it's necessary or is appropriate at this particular time. I think if we pay attention, you know, carefully to a lot of the conversation that we've had today, and we take the pain to actually familiarize ourselves with the bills, we will see that overall, if anything, I believe a significant part of this bill is actually aimed at providing some bit of succor. All right. And I'm careful with the choice of word, because ultimately the objective of you know, tax administration or tax modernization is not only to make the process more efficient, they also want to increase the tax yield and the tax take. So we must recognize that, and we mustn't hide away from that. But in an attempt to increase your tax yield, increase your tax take, you can do that through various ways. You can do that by ensuring that, you know, the base is widened so that those who are supposed to pay and have the capacity to pay and are not currently paying, you bring them into the tax net. Now, that, as an example, is part of what this bill is seeking to do. Now, but while you are doing that, you're also mindful of the fact that the vulnerable, where the pain is more and where the shock absorber is less, you know, where the bandwidth for managing some of this pain it's non-existent or too low, you also provide enough cushion. To a very reasonable extent, that was done. So currently, I think it's in fact, you have a minimum tax of 1% in our current tax law, irrespective of whatever you earn. A minimum tax of about 1%. The highest tax band, the marginal tax rate, is 24%. That rate kicked in at taxable income that is above 3.2 million naira, for example. Now, if you gross it up, if you gross up what's, you know, chargeable income that is above 3.2 million that you are taxing at 24%, if you gross that up, even with the consolidated relief allowance, all right, if you take all of the benefits away, consolidated relief allowance and all of that, let's say you gross that 3.2 up to say, you know, represent 80% of the, you know, of the income. You're talking of 4 million naira gross earning that is being taxed at marginal rate of 24%. Now, you need to earn over 25 million naira to even get to the band of 21%. All right, 50 million naira, everything together, you are still being taxed below the current band of 24%, and you need to be, you know, a significant HNI, maybe 100 million and above, before your band gets higher. So what I'm saying in effect is that the reform is actually doing exactly what that question is seeking to say. There is pain. What relief is the government thinking about? So when you hear tax or tax reform, it doesn't necessarily mean tax everybody more. So provides relief to the vulnerable, individuals, SMEs, you know, even if you're an individual and you're not an SME, but you are consuming, you know, you are buying essential items, or you are paying for rent, or you are paying for healthcare, you are paying for education, all of those are still exempted. Now, but recognizing the fact that the government still need money, by the way, our debt is ballooning. And so the fact that we are in a crisis situation doesn't mean the government no longer need money. So what the reform then tried to do is to shift that burden a little to where the capacity to pay, it's existing. And that's why the real HNI will pay, significantly more. And it's truth be told, a significant portion of these HNIs are probably not in the tax bracket. The individuals that are paying personal income taxes are essentially those who are under the PAYE scheme, who are employees. So we need to actually also focus on those particular areas. We need to close the gaps for large multinationals while providing relief, while making the environment, the business environment more conducive for business. We also need to be mindful of the fact that if there are leakages from our own system, multinationals will pay, in other regimes. For example, if the global minimum tax pillar 2, comes into effect. So I think it's a little bit of a balance. That's the point I'm trying to make. So the reform provides relief for those that really need it, and essentially look to those who have the capacity to pay to say, look, it's not going to be easy to pay, but we at least will make the process simple, we'll simplify, we'll reduce the burden, but at the end of the day, we'll cough it out. And if you know how tax rules work around the world, most companies are not so much focused only on just the rates alone. Our rates are, to a very large extent, competitive. Excuse me for saying that, because I also understand the context. I understand all the informal taxes we pay and all of the burden we bear. But even if we move from 7.5% to 10%, with all of the eligible input VAT, if we compare that to our peers across the continent, not even going abroad, we won't say our rates have ballooned. If you look at our personal income tax rate, and we have the highest headline rate to marginal rate of 25, and you compare that, you will say, we are the worst, even for our peers. So that's just the balance that I think is being done. Provide relief where it is really critical and necessary, and try to focus on where the ability to pay is assured, and widen the gap. But why those individuals are paying, make the process simple, let it be efficient, reduce the number of hours that taxpayer needs to invest in compliance, and hopefully that will lessen the burden. So for those who pay more, the process is simple. And for those who earn less, they have some bit of relief and pushing. So that's how I think I can say respond to that question.
Thank you for doing justice to the question. I think we are going to take 2 more questions. We have so many questions. So we take 2 more questions because of our time. And so the next question now is, what is the possibility that these bills will be passed by the National Assembly, and what is the timeline? What is the possibility that these bills will be passed by the National Assembly, and what is the timeline?
Let's make Albert the soothsayer.
Thank you very much. I can take that very well. I work with the National Assembly on some of these finance acts, and I know the processes that it will take. As it is, a couple of weeks ago or last week, the House of Rep had a whole day deliberation on the bills altogether, and I was present. And whatever we're saying now is to support or to make a presentation to the National Assembly, because even the president cannot change the bill as it is. Okay, it has been passed to the National Assembly and it is left to them. It was made clear also to them in terms of the aggression around the 60% derivation, that the ball is in the court of the National Assembly to determine what it is. It's not the committee just made everything that is before the National Assembly is mere proposal, which can be amended and passed as they wish. And so that is the process ongoing. Very soon, I know that they will commence public hearing on the bills by both whether they do it jointly or individually by the Senate and the House of Rep. After that, they will go into internal retreat to review all the submission by ICAN, CITN, all the institutions, all the insurance companies, every concerned parties that have made written representation. All of those will be reviewed vis-a-vis what is already in the bill, the issue around minimum tax or 15%, you know, if you convert 750 million euro to Naira today, it is 1.6 trillion. And so how many companies are in that bracket in Nigeria? And it's supposed to also, like Nick has mentioned, it's supposed to look at the global turnover, not the individual company. And so all of those are being presented and being reviewed. So the National Assembly will review all the submission. They will engage experts that they want to engage. They will engage the Governors Forum if they want, and all that, and then come up with what they will present to the whole House for review and passage. So I can say with some confidence that I'm sure the bill will be passed. That's one. And the timeline, I may not be able to say, but I'm hopeful that it won't go beyond the first quarter if it is not before the end of the year. It won't go beyond the first quarter of next year. And as soon as the bill is passed, you have and assented to by the president, who will also enjoy the 90 days as proposed by the National Tax Policy for people to familiarize with the provision of the law. I also wanted to just make additional comment on what Yomi stated, why the reform now. We need, as professionals, to take our time to go through the bills one by one. Every sentence is law, and we really need to familiarize. If you take it from corporate tax, ordinary what is allowable as an expense, we already know the wholly, exclusively, necessarily, all of those are no longer there. We only have wholly and exclusively. Okay, if you look at the early sections, we have issue around private company where your profit is deemed to have been distributed, even for closed companies. The definition has been amended to suit what it is done globally. So there are quite a number of things. The Stamp Duties Act has been reviewed properly. It was a 1939 Act, okay? And we cannot continue with all the issues that have been brought into stamp duty, such that some people are even charging provisions that are not in the law, 1% on contract, and so many things. So we just need to zero down on most of the provision. When people were arguing around the stamp duty, the VAT, they were also commenting around even the foreign exchange. That may even be more significant to a lot of people than even the stamp duty. So definitely the time is right, and we definitely need a reform at this time. And at the end of the day, on balance of probability, from my own view, is not tilted to favor any sector in terms of other than the low-income earners. Because even for companies, if you are going to be eligible to deduct your input VAT and on your fixed asset and expenses, we don't expect you to increase. It's going to reduce even your cost. And therefore, you should, even though we know that it will increase the headline rate, since we are increasing the rate, at the first tranche of 10%, government is likely going to be out of pocket. By the time you move to 12.5%, maybe the government will be breaking even. And then they will start probably making something out of it by the time the rate move on to 15%. And I think those are the way we should look at this bill. And I believe that it will go through and will be passed to law soonest. Thank you very much.
Thank you, sir. We appreciate you. So we believe that the bills will be passed very soon by the grace of God. Now, the last but not the least question is, some states are complaining about the impact of these proposals on their revenue. What are the real issues and how can this be addressed? Some states are complaining about the impact of these proposals on their revenue. What are the real issues and how can this be addressed? That will be the last question. And I think our honorable from Jigawa State will help us do justice to this question. Thank you, sir.
Yes. Thank you very much. Yes, thank you very much. The real issues have been explained already in my presentation. The real issues include Section 77 of the proposed bill, which changes revenue sharing formula. That's the value added tax sharing formula from what it used to be. Because the sharing formula, especially the horizontal sharing, if you look at it, 30% was allocated to population, while 50% was allocated to equality. So by that, some states have been benefiting, even if the value added has not been driving from their states. So by introducing the new formula has brought an element of fiscal federalism, that is, by de-emphasizing the principle of equality and adopting the principle of derivation. So by so doing, you know, as I said earlier, once you introduce element of fiscal federalism in your arrangement, you are bound by the benefits and also disadvantages associated with fiscal federalism. One of the disadvantages that are associated with fiscal federalism is that the issue of need. There are some areas, even though if you look at the derivation, the tax might not have been driving much from that area, but they need to be taken care of because of their need. If you also, some of the states, what they are saying is that some areas, some states in the federation are more developed, are in a better position to drive more value-added tax from the new sharing formula by virtue of their location, by virtue of their maybe being the federal FCT before. Some states, if you take like Calabar and Lagos, they were the federal capital territory before. So most of the developments, the developmental projects were located there, and the resources used to develop these areas are the resources of the entire country. So now, what some of these critics are saying is that these areas, if you look at it, what are you going to do to those who happen to be in need? But by virtue of their location, you know, each state, each subnational has its own viability when it comes to internally generated revenue. However, I feel that, as I explained earlier, these concerns raised by some of the states can be addressed by investing more in the area of production, investing more in the real sector, thereby developing the economy in order of these states in order to generate more revenue. So I believe that the governors of these states should look inward, should begin to look inward for the development of their state economy, because as I said earlier, the internally generated revenue is a function of economic activities in the state. So by investing in the real sector, you will be able to boost economic activities in the state, thereby increasing the level of revenue generation in the state. However, there are some attempts by the proposed bill to address this imbalance in the revenue sharing. For example, by keeping aside 5% of the amount standing at the account going to the states, that 5% will be used to compensate any state that happened to get less than what it should have gotten under the old sharing formula. So I think this 5% will go a long way in compensating for the imbalance. Also, if you look at it, most of the productions in the northern Nigeria are that of agricultural productions. Most of these items are zero rated. So by incorporating zero-rated items in the derivation formula. I think the proposed bill has made an attempt to balance the imbalance in the area of the value-added tax sharing. However, I advise those states that are affected to go back and harness the resources in their states to develop economic activities to generate more investments, thereby increasing the level of economic activities in their state. This will go a long way in addressing the imbalance, if any, to be brought by the new sharing formula. Thank you very much.
Thank you, Honorable Sir.
Can I add to that, please?
Yes.
Thank you
I
very
wanted
much.
to call you. I saw your hand raised.
Yes. So I know that for some states that have developed in their internal revenue generation, their concern is that most of the areas of focus, are part of those nuisance taxes that we believe should be synchronized and harmonized under the harmonized tax. And they're going to probably be losing out on some of them. For example, if we take Lagos State as an example, the hotel taxes, they will no longer be able to collect that under the new dispensation. There are states like Kaduna who have expanded their collection to different types of things, motor vehicle, bicycle, and all of that. Several states, including Ondo State. And so they will be losing out on those areas, and they believe that if they are not adequately compensated by the structure of the new sharing and taxes that they believe will now be available to them, particularly when we know that 100% of stamp duty goes to the state, virtually 90% of VAT go to state and local government, and all that. So they believe if all of those are not properly, distributed, they may be out of pocket. And those are the major concern of some of those states, not necessarily even this sharing formula. But of course, again, if they are familiar with the sharing formula, which for a particular month, the total VAT distributable was 489, out of which 207 went to Lagos State, 72 to FCT, 48 to Rivers, and so on. So taking about 72% of that, there is no formula you can bring up that will be worse than that. So as long as they are able to understand that if derivation is properly done based on attribution, which can be done by even without technology. Before now, companies used to file VAT returns on the basis of their branches and location, and that immediately will give you details of how much VAT has been generated per state. And with technology, that can even be done better. And I have had details of telecoms like MTN being able to provide details of where calls are emanating from to determine where the call is coming, to determine where the VAT on such calls will be attributed. So if all of these are made known to everyone and they understand the fact that the distribution formula cannot be worse than what we have now, I'm sure they will buy into it. And a lot of people in the National Assembly are getting educated and on the details of the bill, and I believe that it will get better attention. Rating than what it was at the start. Thank you very much.
Thank you very much, sir. I want to call on one of the council member, Mr. Austin Irem. You raised your hand, sir.
Yes, I did. Good afternoon. Please, can you hear me?
Yes, sir. We can hear you clearly.
Oh, okay. Thank you, Dr. Yemisi, the moderator. Thank you, our Diamond President, Chief Alaribe, for putting this together, and also the chairman of the tax faculty and all the invited panelists. A laudable legislation being put together by the presidential committee. However, I have two specific concerns that I want to share on this platform, and hope that probably it will get to the right quarters. One, in Nigeria of late, we've been doing a whole lot with respect to the devolution of powers to subnationals. Recently, the power sector has been decentralized to the extent that state governments and even companies and individuals can now generate power, transmit, and distribute. Same goes with rail transport, where states can even go into rail transportation. But here, we are talking about centralizing our tax system. You know, so is that not contradictory to the position that we as a nation is canvassing? At this point, what I think should be paramount to us as a nation is how do we build capacity? Because that's what I hear. Do the subnationals, do they have the capacity to drive the tax collection process? So I think what will be of great importance to us is how to build capacity of our subnationals so that they can collect effectively and efficiently taxes due to them, and not centralizing everything at the center. That's one. Two, the issue of increasing the zero tax rate with respect to personal income tax and even company income tax from, let's say, 200,000 to 800,000, and from 25 million to 50 million. Laudable initiative, but as laudable as that might be, does that not amount to us legislating inflation into law? Why do I say this? We arrived at where we are as a result of increases in price. So if we now say that those earning below 800,000 should not pay tax, and companies that have turnover of 500 million and below shouldn't also pay tax, is that not an indirect way of accepting the inflation-induced prices on us as a nation? As a nation, are we not supposed to be working towards reducing costs, both for companies and for individuals? These are just my concerns. Thank you very much for the opportunity.
Dr. I think I see
Hello,
the
sir.
IPP. Yeah, okay. I wanted you to.
Yes, sir. Yes, we have one more hand raised. That's the high PP, Dr. Innocent Okosa.
And the second DVP, please.
Oh, sorry, sir. And the second DVP. So let's take the second DVP first. You have not spoken. You have not spoken.
Yes, thank you so very much. Thank you so very much.
Yes, sir.
I observe the protocol that has been established, and I want to thank everybody within the value chain process of bringing this program to the fore. I am a little bit concerned about the last speaker that we will need full understanding of what the federal government is trying to do. When this program started, we were made to understand that the Rivers State government and later the Lagos State government took the federal government, took FIROS to court. Now, and the FIROS, and which is the mouthpiece of the federal government as far as revenue is concerned, is acting more like bullying the subnationals into submission. I would very much want to know the issue of VAT. Is it not outside the scope of the federal government? Why are they trying to legislate VAT that the constitution of the nation has already established belongs to the subnationals? That their inefficiency in collection is apparent, is not justifying the reason why you should go and take the tough that belongs to them to legislate on. Why not concentrate on your own core competencies and train the subnationals to reach the efficiency level and surpass it and collect what is collectible by them? That is, I joined Mr. Irem, who has posited on this issue, and that is, I'm attaching my voice to him. Thank you so much. I've finished.
Thank you so much, sir. Thank you very much. Please, who is going to attend to the question?
Okay.
Chairman, sir.
Thank you, Doctor. Okay.
Yes, you have the floor, sir. Right on.
Okay. Thank you very much, Doctor. I believe that, Doctor, as you said, that inefficiency on the part of the subnationals is not enough reason for the federal government to take over the administration of the value-added tax. I believe that you see, as we are moving towards consolidation of the process of revenue collection, there is need for harmony in the system. Also, the issue of the efficiency is a very serious issue because the federal government has the necessary. If you recall that the value-added tax law was developed by the federal government, I think, during the military administration. I know that I believe eventually we will come to a stage where state governments will be given the opportunity to administer the value-added tax laws. However, I believe that going by the level of efficiency in the subnationals, they are yet to be mature enough to be handed over the process of value-added tax collection. Thank you very much, sir.
Okay. So, can I say something around it?
Yes, you can say something.
We know that in 1986, the sales tax was introduced and it was being administered by the states. And we know how that went. And that was what brought about the main reason why in 1993, when the VAT value-added tax was introduced, it was made a federal tax to be administered at the central level. And of course, if you look at VAT as opposed to sales tax, if you look at countries where proper VAT is being practiced, and that is why we even need this reform more than ever, where you have, VAT is a value-added tax. It devolves in successive stages, such that at the end of the day, it is the final consumer that bears the burden. And so if you produce goods in Lagos, takes to Calabar, from Calabar, somebody distributes to another state nearby, you need a central system that will be able to determine how much value has been added at each stage of the distribution chain. So asking a state, for example, to legislate, if you go through what Rivers State and what Lagos State drafted as their VAT law when they were attempting to administer it by themselves, you wonder how that would be possible, what they have put together. So it is clearly it is very clear that for now, it is difficult, except we're not talking about value-added tax. Maybe we're talking sales tax. Then we can say each state can start charging sales tax, as it's done in some countries, including US. But as far as value-added tax is concerned, with the level of our technology and knowledge, and with the way VAT is supposed to be administered properly, where you have input and output, can only be done centrally for now. And I don't think it's about bullying anybody, particularly when you are sharing and taking 90% of the revenue generated. Even if you want maybe I believe that the 15% that have gone down to 10 can still go down, as long as at the end of the day, the tax is being consumed as provided in the Constitution by the state. The same thing applies to stamp duty. 100% of stamp duty belongs to the state. And therefore, whether it's collected by federal or state, it goes to the state. One way or the other, it must be administered, it must be consumed by the state. And I don't think there is any bullying or trying to circumvent the power of any state here. I'm sure the state will be happy with the increase that is expected on fiscalization of VAT process and all the processes that have been put in place, particularly as enshrined in this draft bill. Thank you very much.
Thank you very much, sir. IPP, sir.
All right. Thank you. I want maybe Valorisho Albert, or the chair, the guest speaker, Mr. Alomulo, to I know somebody spoke on penalties and help making it possible for people not to violate the tax something. Okay, by the way, I want to make it clear, I'm part of the committee. The points I'm raising are not for my own understanding. The point I'm raising is for the audience to understand and have a critical look at each section as I've been advised. So when you go to the penalty section, you will see that some of them impose a fine of 1 million naira. Some are saying first day 350,000 and subsequently 50,000 naira a day for which the offense remain committed or something like that. In an environment where people are complaining about these reforms and the impact on their income and what they're. Can you speak to the penalties? Are they too much? Are they commensurate? Will it actually bring deterrence to offending parties? Or is it going to kill? Is it going to cripple the person and then make it difficult for the man to survive as a human being? Because one thing is for you to put this in the provision, another thing is for those who are going to implement. How do we need to strike a balance in all these? Thank you.
Thank you, IPP. I was going to officially announce you as that the member of the committee, you represent the institute, you led us. So thank you, sir, for letting the cat out of the bag. So and I appreciate that question. Maybe Albert will also come in. I think, like you said, there may be a need for review where some specific element. I don't have the full list of all of the penalties offhand. I have a fair idea of some part of the provisions, but I think the driving force is the word you use, which is around deterrent, and you need to really drive the compliance culture. So remember that for the first instance, there are at least two things that has already been done to make sure that penalties are not just imposed just with a view to just generating revenue alone. So number one, the people who are really very vulnerable, who ideally don't even have the capacity to pay, either from a business tax perspective or from a personal tax perspective, have already been exempted. In terms of their tax obligation. So if someone's income is exempted and there is an obligation to file the return, I think it's also important that the penalty is sufficient enough, or at least is punitive enough to ensure that the responsibility is taken very serious. I think that is the philosophy, but whether the committee or the proposal landed on what is ideal, the jury is out there, and we can contribute. We can look at it again. There is also the introduction of the Office of the Ombuds, that I did mention. I related quite extensively with the madam leading that role for South Africa, and twice in the last, I think once in October and earlier this month, we met in South Africa. I met him in Dubai at different conferences, and we had very extensive conversation. What that role, what they play for the SME and the individual who ideally could have this type of burden of penalties so heavy on them, the Ombuds Office actually helped them quite a lot to challenge unfair assessments, instances where the reason for the defaults, it should be excusable under some humanitarian or some, other kind of general rule. So there are quite a lot of, responsibility that the Ombuds Office will help if the assessment is unfair or the penalty is being, is just being administered discriminatorily by the Revenue Authority. They essentially just serve as the tax advocate that can take on the Revenue Authority. Now, but for the large multinationals who are expected to, have established maybe tax offices, and have tax officers within their business, it's very important that they also recognize the fact that the penalty is steep. So I think it is those kind of balance that I believe led to the rate. If we say 50,000 naira, for example, let's say there's a particular penalty that say 50,000 naira. In today's time, 50,000 naira is less than $30, right? So if there's a penalty that is 500,000 naira, that 500,000 naira is is probably something within maybe 300 or or thereabout. So in terms of USD, so I think now the devaluation in the currency itself could have played a part on it. But I think more importantly, maybe moving towards a percentage based, a relative based penalty regime rather than fixed absolute number. So maybe that can be a consideration. So when we are looking at the responses to what we're going to be submitting to the council, we also take a more extensive look at the tax administration bill to see whether there are few cases and point attention to it. But that's essentially how the proposal, as you rightly know, Dr. I know Falonshop came on. I don't know whether he was intending to add any perspective.
Yeah, just a few things. So penalty or interest, as the case may be, is ordinarily not supposed to be a major source of revenue, even though we know in some countries is a budgeted source of revenue. And so for me, as far as the penalty and interest is clearly stated and can be understood from beginning, okay, and is not one that will induce corruption. When you put penalties that taxpayer will not be able to pay, you are just inducing corruption such that you'll be begging up and down and all of the associated points. For example, like the IPP mentioned, the issue of 1 million penalty for failure to make attribution, is vague, just like we have in the Section 85 around the filing of payee returns. It's vague. We need to be able to state specifically, is it just one return or all of the return, or as long as until I'm convicted by a court of competent jurisdiction All of those things, I believe, are things we must put forward. 1 million failure to make attribution did not say how many times, because every month I'm supposed to file a return and state which state I have generated. That is attribution. You, in that manner, you state how much VAT as a company like MTN, you attribute all your VAT collection to respective state for the purpose of this derivation to be possible. And it says 1 million for failure to make attribution. Is it the first month, second month, third month? That has to be clearly stated. When penalty is vague and unclear, it becomes difficult to comply with, and when it's difficult to comply with, it breeds corruption. For example, we have in existence where our penalties now are tied to monetary policy rate, I mean, particularly the interest. Yesterday now, we understand that it has moved up to 27.5% from 27.25%. And FRS will definitely come and say that plus a 5% on top of that is now their new rate, and which obviously there's no business you are doing that you'll be able to pay such a huge penalty. It breeds corruption. It brings avoidance instead of encouraging compliance. And I agree with the former Oga Innocent that this is an area must be looked at. It shouldn't be too much that people cannot comply, and it should be enough for people to at least to encourage compliance, and not that which will breed people flouting the process by trying to find a way around it. I agree with him totally. Thank you very much.
Thank you very much, sir. Thank you, Mr. Chairman, sir, the lead speaker, and all the panelists. We appreciate you all. Today's discussion has provided a platform for stakeholders to share their perspectives, identify challenges, and explore opportunities for improving the tax reform bills. So we hope this our discussion that the insight gained from the discussion will inform and influence the ongoing reform process. On this note, I want to invite the Vice President of the Institute, Malam Aruna Umayaya, MNI FCA, to give us the vote of thanks. Thank you.
Thank you. Good afternoon, everybody. Are you hearing me?
Yes, sir. Clearly, sir.
Okay, thank you very much. The panelists, you've done very good to the topic. The essence of this webinar is to inform our members and general public about the tax reform bills, the nitty-gritty of the bill, and also to convince the general public the merits and, if possible, demerit of the bill. Let all be apolitical and look at it from the professional perspective. So on behalf of the 60th President, Chief DCS Alarive, FCA, I thank the speaker, Mr. Yomi Olugbero, for wonderful presentation, and also the panelists who has done very well to the topic, starting with my friend, Mr. Alba Folorusho, Mr. Kunle Oyetoya, and Mrs. Nike James, and Alhaji Nasiri Sabo Idris for answering all our questions and providing insights to the discussion. We appreciate your perspectives, and members are agitating that your presentation, the soft copy, should be sent to Secretariat so that we can send it to members. They can read and also be our champions in their respective area to propagate the ideals of the Institute with regard to the tax reform bills. Also to participants, without you, there will be no webinar, because if it is only speaker and the panelists that are there, we will not have robust discussion. We appreciate your time to participate and also your comments, both that you send online and those who ask questions. We thank you very much for your active participation. So now you have proper insights of the bill. We encourage everybody to go and read again what the bill entails, the details of it, so that you'll be able to convince and discuss professionally with the politicians in your jurisdictions. We also like to thank the anchor person, Dr. Yemisi, for organizing this session and taking us through the time. We thank you very much. The secretarial staff that supports Dr. Yemisi in hosting this webinar, from the IT officers and other secretarial staff headed by the RCE, we thank you for making it possible. At the end of this discussion, we will produce a position paper, which already we have, but the new perspective based on this discussion, we will embellish the presentation and issue or publish the position paper immediately. So I thank you all for coming and wish us successful outing to the public to propagate ideal of this reform bill from ICAN perspectives. Thank you very much. Have a wonderful day. Thank you. Bye.
Thank you very much, sir. Now we take the ICAN and the national anthem.
Let's go, ICAN fount of treasure in triumph of banner raised, standing stronger in harmony, building our land together. Dreams of the founding fathers, we are striving to attain our hopes and values that we share. Through all ages we sustain. Institute of Chartered Accountants of Nigeria. Noble ICAN, your accuracy we cherish. We uphold your integrity. Nigeria, we hail thee, our own dear native land. Though tribe and tongue may differ, in brotherhood we stand. Nigerians old and proud to serve our sovereign fatherland.
Thank you all. Have a wonderful day.